and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Look at the Taiwan index managing to hold on to gains of 3.37%.
India is a key part of their overall global back to Starbucks plan.
And if you don't get it fixed fast, I'm going to fire your ass, okay?
Support which has moved higher and higher. I mean, basically the 20 days, being dragged higher.
Macquarie has upgraded the stock to outperform, and target here is 6,793 per share.
A third higher on the Nifty, 26,100 passed on the Nifty.
Earnings were much better than the consensus. Don't compare YOY or quarter-on-quarter, but compare with the consensus, so it was far superior.
Honorable Supreme Court also said that we have not expressed any opinion against Sanman Capital.
The Nifty very close to the day's high right now. It's above the 26,100 mark.
For the first 9 months of the year, Nvidia has reported sales of close to $150 billion.
I think we should certainly grow between 6 to 7%. I think we have potential to grow beyond 7% as well.
Adani Enterprises has notified exchanges that its resolution plan received the highest number of votes from the COC, and lenders have now issued a letter of intent to the company as well.
That rally that we saw yesterday has continued. We are sitting with gains of 150 points. Nifty is above that 26,200 mark.
Good afternoon, hello, and welcome to this edition of Closing Bell. We're coming to you, as always, from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me is Nigel D'Souza. In the morning, I was asking Nigel, what's going to happen? 26,100. And he said, all-time high in November.
Yes.
Nifty is teasing, saying, Nigel, do you want it today or not? But it's astounding, right? We came, I think, just about 40 points away from that level. There's a lot of momentum in the market. Yeah. Let's see.
I think, Surabhi, even on 30th of October, you guys were talking about the all-time high, but I wasn't there. It didn't happen. I think either today or tomorrow, that all-time high is there. It's a matter of 50, 60 points or thereabouts. But it's a good performance, but you need to caveat it by saying that that left-out feeling. Portfolios are not feeling like all-time highs. Stocks are still down 20, 30%. So the broader market participation needs to come about. But the good news is the banks, the heavyweights, Reliance Industries, they are taking the Nifty to all-time highs. So for the time being, the bulls will be happy that the headline index is going to those all-time highs. But the greatest satisfaction will come once the broader markets start participating.
Absolutely, I take that point. But and there's the slight wobble that started happening now. It's a very crucial 1 hour. So that Nifty chart that you just saw over there, where we're just off the highest level. This is the tally as it's looking like today. Reliance has been such a massive support for the market. Yeah, that's what I'm talking about. So just a bit of a wobble from the top and profit-taking setting in, which you can't blame anyone for, right? I mean, it's been a remarkable rally, a rally of almost 1,000 points from the lows of 25,300 thereabouts. So at highs, there is a natural profit-taking. But remember, yesterday, the FPI numbers were positive. And what's heartening, Nigel, is that today, while the rest of the world is back, because this whole AI trade is back on after those NVIDIA numbers, but it's not like we've completely sold out, at least not as yet. But let's not jinx it. We still have one whole hour of trade. The bulls will want to take these gains home. They would want to end on a high, on a winning note. So plenty lined up. Let's actually just get that the Nifty composition chart back on to give you a sense of what's led. It's actually a pretty wide rally on the large cap screen, at least. Reliance obviously is playing a big part, but a lot of auto stocks have done well. iShares, by the way, is up about 3.5% as we speak. Some of the banks are chipping in quite nicely. So it's pretty well spread out, at least for the time being. We'll tell you more as we go along, and also mid caps and what the big newsmakers are looking like. But for the time being, let's tell you about today's show lineup. And as always, we have plenty coming your way over the next 1 hour. The Nifty is racing towards record highs. FMCG and auto stocks are leading from the front. Banks, relative underperformers in today's trade. We'll get you more on this and some trading ideas in just a bit. The Mahindra Group has laid down ambitious growth plans as it's at its Investor Day. It is aiming to become the world's fastest growing SUV brand. And it has also hiked its forecast for its tractor business. More coming up on this with Sudarshan in a bit. Hero MotoCorp's rally also continues after Macquarie upgrades the stock to an overweight rating. We'll tell you more about Hero Moto as we go along. And then views coming in from an exclusive conversation with Prashant Jain of 3P Investment Advisors. Prashant is raising a bit of a flag of caution on IPOs and new listings. That's a conversation that you don't want to miss in any case. Let's get started then. How should you position yourself for the remaining 55 odd minutes of trade? We've got Mitesh joining in. Mitesh, what a phenomenal rally it's been, right? But you can see the nervousness now. Some people are saying, "Bahut ho gaya, acha run. Let's take the gains home and go home." What would your advice be for the last hour?
I think from a trading point of view, the advice always is that, till the index itself tells you that I'm trying to go down, let's not preempt that. What traders can do possibly is trail the stock to about 26,080. That's where, we had seen some hourly closings first on the 23rd of October and then on the 29th of October. So as long as now we are above that, I think, believe that the trend is on the upside. Only a break below that would suggest that profit booking or some kind of corrective pullback has started. So that's one. Two, I think, when you approach all-time highs, yes, there's always this idea of taking profits. But looking at the indicators, I think, there still could be a chance of the markets catching up. So therefore, I think, keep a close watch on 26 to 300 zones. Once we clear them, we are into all-time highs, which means that no historical resistance is there. And therefore, it could be very interesting on the upside. On the stock side, I have a buy on HDFC Bank, which I would recommend buying with the stop at 995 for the targets of 1,030 to begin with. And Dabur is a buy with a stop at 519 for targets of 540.
Okay, all right. Thanks a lot for that, Mitesh. By the way, just pull up Physics Wala. The stock was down, I think, 13% or thereabouts. There's been a bit of a recovery from the lows. It had a blockbuster listing and then it lost its way a little bit. Physics Wala should come up for you on the screen. Suddenly, a big bounce, I think 123 to around 136. Plenty of volatility on these sort of counters. While Grow is still down. It's down more than 5%, I think, the last time I checked. So a couple of these debutants in focus in today's trading session, now down close to around 7.5%. But Mahindra Group's Investor Day is underway and the company has set out some ambitious growth targets. The conglomerate targets organic growth of around 15 to around 40% across businesses till 2030. It aims to be the world's fastest growing SUV brand and the #1 LCV brand, and targets 5 times AUM growth in lending and a turnaround in Tech Mahindra by FY27. Sudarshan is now joining in to help us out with some key highlights out there. Sudarshan, you've been going through it. I saw you on the earlier show. I think you were talking about being a hero and dancing or something. I believe you've rehearsed your steps, so you could do the step first and then go ahead with the link, or vice versa.
So first I'll talk about Mahindra Group. It's holding the biggest ever investor day where all the 12 group CEOs are participating, and ahead of the investor day, these group companies have released details on the exchanges giving the very strong outlook over the next few years. So as a group, over FY22 to 25, the organic growth was 25%. Now going forward for FY26 to 30, now the target is in the range of 15% on the lower side, and on the upside, it's as high as 40%. Now coming to revenue outlook, where the group has given for 1 decade, that is from FY20 to FY30. For SUV and LCV, the growth target is 8 times. Tractor, 3 times. Truck and bus, which used to be earlier known as SML Isuzu, 6 times. And for Mahindra Last Mile Mobility, the growth target is 6 times. Coming to the market share, for LCV less than 3.5 tons, in FY25, market share was 51.7. Now, in FY26, it's seen rising to 54.1%. For SUV, in FY25, market share was 22.7%. That can increase to more than 26%, that is to 26.4%. For tractor outlook, the group companies have raised the outlook till FY30. So earlier, tractor industry outlook for FY25 to 30 was 7% CAGR. Now it's been increased to 9%, and demand would be raised by the company group is seeing demand for higher horsepower tractors, that is in the range of 40 to 50. They've also mentioned few aspirations. For SUV, they want to be world's fastest growing SUV brand. LCV, they want to be #1 brand across segments and applications. For tractor, they want to transform lives of farmers globally by democratizing technology. For truck and bus, they want to be amongst top 3 in India's ILCV trucks, that is basically school bus and truck, focused mainly in higher commercial vehicles. In EV, they want to be number one in eCV company with 1 million EVs on road by 2031. For M&M Finance, they want to be amongst most trusted financial services provider for Bharat. So it means they want to focus on rural area, and till FY30, they see 5 times AUM growth. For Tech Mahindra, turnaround is expected to be completed by FY27. On a similar trend, they have a huge target for Mahindra Holidays and Mahindra Life also. So big investor day and a big outlook by Mahindra Group.
And the dance step?
That's for tomorrow. I don't think Nifty is looking to hit the record high. It's back now. Again, we are around 70 points away from that level.
So you're promising us this. When we hit the record high, you're going to be doing a jig of your own.
We'll do together.
Absolutely.
I don't know what these boys are cooking up, but I'm really looking forward to it. I have no clue what's transpired between the two of them, but this is sounding very, very interesting. All right. So awaiting some excitement.
You can join in, so we don't feel left out.
I'll clap. I'll clap. Let the all-time high happen, and then the boys can take it away. All right. Let's actually, since we're talking M&M, let's also talk about Mahindra and Mahindra's holidays business. M&M, of course, spoke about that at the Investor Day as well. And we caught up with Manoj Bhatt, the MD and CEO of Mahindra Holidays, to learn more about the company's foray into the leisure hospitality business. They've just announced this investment of about 1,000 crore rupees. Listen in.
What gives you the right to win in that space, which is fairly competitive, and you already have large incumbents? What will be the key differentiator for you?
Thank you, Shireen. So as we looked at the market, clearly, the first part I would talk about is what we have built over the last 27, 28 years is this whole association with family and creating, almost defining family holidays in India. And as we looked at the broader space, we felt that there's a wide space there where nobody is focusing on in creating premium family holidays. And that's one of the space we want to occupy. And that actually combines some of the strengths we have historically. Secondly, of course, we are a very large chain. Today, we are number 3 in leisure hospitality by rooms. And so clearly, we have the expertise to actually scale up and run at scale. So that's the second point. And lastly, I do feel that experience is going to be the new currency. And if you look at experiential holidays, I think in a survey, 80% said they would want an experiential holiday rather than a normal holiday. And as we think about that, if you look at what we do today, experience is embedded in what we do today also. I think that's the third leverage which we want to bring into this business. I think scaling the core to 10,000 keys, I think that remains a big priority too. And as we think about it, I think whatever we have put as a decadal vision, it really translates to double the keys, double the revenues, and triple the profits from here on in the next 5 years. So I think that's the way we think about it, that we really have to focus on both of these. And of course, Signature Resorts is the new initiative. So obviously it will take a lot of time and attention, but scaling the core remains important.
Okay, let's go across to Deepak Shenoy, founder, Capital Mind, who joins us on the show. Hi, Deepak. A while since we spoke. What's the view on the group, Mahindra and Mahindra? You know, the investor day is on. The Mahindra Holidays top boss, so they're sounding extremely confident and optimistic. What's your take?
Yeah, overall, I think no, individual companies, I won't give any opinion here, Nigel. But I think specifically here we are talking about company that is in many spaces. You know, like you said, they're in holidays, they're in they have a tech arm, they have many engineering arms apart from their core auto business, which itself is divided into personal vehicles, trucks, and tractors. So there is a fairly large diversification here, and pretty much an India story here, in the sense most of their work happens towards and selling in India for the most part, other than the Tech Mahindra business. I think overall, it's been one of the older groups in India that perhaps took a while to kind of come together. There's been some consolidation, some rejig within the group in the last decade. It's an interesting space for them to be, because they're not meaningfully yet in financial services and some of the other areas, but they have footprints in almost every industry, and it'll be interesting to see what plans they have going forward. They're probably now the second largest car or personal car manufacturing company in terms of size, in terms of number of vehicles sold, and they've caught up very quickly, especially in the higher end car space in India. So I think that's an interesting place for them to be. There are other things that they can do. They're doing a bunch of things in EV. They can do a bunch more things in two-wheelers, perhaps, and other things. Would like to wait to see where they're going. As a disclosure, we may own some of these companies in the group in our group businesses.
Okay. Fair point. Stay on. We'll just come back to you, Deepak. Lots more to discuss and talk about. But back to Sudarshan. He's watching out for Hero MotoCorp as well. It's reacting quite well to a brokerage upgrade that came through. Sud, fill us in.
So it's the third upgrade since Q2 earnings of Hero MotoCorp. That's basically in last 2 weeks, and the second upgrade in 2 days. And there are several reasons to. If you remember, after Q2 earnings, we were talking about that company has outperformed the peers on majority of the metrics. And if you take a look at the share price, it's up almost 50% this year. Now it's less than 200 points, or basically less than rupees 200 per share away from record high. It's crossed rupees 6,000 per share for the first time since September 2024. After JP Morgan's upgrade yesterday, today Macquarie has come out with a note. It has upgraded the stock to outperform, and target here is 6,793 per share. And the reason is, as per Macquarie, domestic market share has stabilized for the last few quarters and sees upside risks in both motorcycles and scooters, and that's basically being led by the new launches that company has been undertaking over the next few days. We also be seeing new launches in the 125cc segment by Maruti, and the another reason is the GST rate cut that company had government had announced in the month of September. That led to a big demand in the entry-level segment. Now the competition also in the entry-level segment, if you talk about 100cc, it has come down, because for TVS Motor and Bajaj Auto, now 100cc segment is not of like huge importance. So competition is between majorly Honda and Hero MotoCorp. Now Street is willing to give higher multiples also. For the last few years, there is a huge discount in the multiples of Hero MotoCorp, and if you compare with the peers. So Catalyst, as per Macquarie, first market share gains that company is seeing in petrol segment. It has, in the festive season also, it has gained the market share, and in the market share is more than 31%. And the volume ramp up that company has been taking in electric two-wheeler. And on the margin front also, company has been performing consistently. This quarter also, it was at multi-quarter high of almost 15%, and it maintains margin outlook in the range of 14 to 16%. So overall, it's a hero move by Hero MotoCorp after several years.
Okay. All right. So Hero MotoCorp indeed making hero moves. Almost 6,000 on the stock today. Deepak, so, let's sort of get a little broader. You mentioned overall thoughts on the M&M group and how well they've done. We actually had a discussion with Fada in the morning, because that's something that a lot of investors are thinking. Some of these auto stocks. Anyway, M&M has been a great wealth creator, even much prior to the GST cuts and all that. But let's say Maruti did so well this year, right? The question is that now that this whole bumper festive season is done, GST is done, is this sustainable demand? So can there be sustainable wealth creation from auto OEMs? Farah told us that their estimates for this year, total PV sales growth should be closer to 6.5%. What's your sense? Can one make good money out of auto stocks?
Well, I think if you look near term, things are going to be neither here nor there. But I think longer term, Surabhi, we actually should see a much better performance going forward. I'm talking about, maybe 1, 2, 3 years from now. There's a bunch of things happening that will probably help this. First of all, affordability. Now, GST cuts will make some of the more expensive cars definitely more affordable, but also change the affordability going forward as well, especially if there's an interest rate cut also that kind of comes down because of lower inflation. And secondly, there is another layer which I think we're talking about. The space itself, I think is poised for an up move simply because there's been a long time after the insurance changes that came in, I think 2017 or 18, when even two-wheelers, the sales were have been stagnant for nearly 5 to 6 years. Many companies haven't even reached their capacities, and a lot of auto companies are still operating below 85% capacity, and that's why there's not so much plant expansions that are happening, capex expansions that are happening. I think I would say the next 2-3 years will involve capex expansions of a more reasonable sort, both from an EV perspective and some other format perspectives for these vehicles. There will be increased demand from tier 2 and tier 3, even for cars, I think, going forward, because the road networks are getting better. I think these will slowly push people, if they're moving into affordable territory, to buy cars instead of two-wheelers, or upgrade their two-wheelers into cars as well. And lastly, availability of electricity as it becomes more widespread. We are likely to see more acceptance of EV among even smaller towns. So these, I think, should give at least auto, which is one of the few areas where we actually have both domestic manufacturing and domestic demand to actually increase. So it's both make in India and make for India. I would say that's where I think the next decade we're going to see a lot more activity. However, I'd say some of these players are a little expensive, but by and large, many of them are in affordable territory right now in terms of prices versus their long-term growth rates. So we are positive in general on auto.
Positive on auto and positive on the market as well. Before we let you go, this broader sense, I mean, Nigel and I were counting down almost all-time highs, if not today, maybe tomorrow. What's the sense? What should one be doing at all-time highs in terms of sectors, what to look at, themes? IPO market is booming. Leave us with some advice.
I think two things. IPO markets booming is, I think, primarily because there's new supply coming into a market that is already seeing a lot of inflows from domestic, both mutual funds and other places and so on. And relatively speaking, some of the foreign investor sales have come down or trickled down a little bit lesser than they used to be. So to that extent, when new opportunities come, people jump at it. But I would say be careful of valuations, especially for new companies, because you want to see them react in the public market space. You want to wait for them to at least do 1 quarter or 2 quarters of results so that you can see how the companies operate under larger public scrutiny, and therefore, get yourself a better handle of things. I'd say India has been taking it on the chin for the last year, for the most part. All the new all-time highs on the Nifty. But if you look at the broad market, we still have a considerable number of stocks, nearly 40% or so, that are significantly more than 15-20% below their all-time highs. A lot of stocks still are trading below even their near-term moving averages. So you're seeing that price performance at a broad level is not anywhere close to what maybe the top level Nifty stocks are. I would say until that broad-based recovery comes, we're not really recovering. And for that, perhaps one of the triggers will be GST, maybe an India trade deal. They've been talking a lot about how they might ease up the rules for Indian businesses to be more productive. There have been maybe there's an interest rate cut in the offing. All of these will probably add to some kind of bullishness around India. And remember, we have grown earnings at a median basis more than 11-12% at a time when inflation is probably averaging 2%. So you have 10% real growth in companies' profits. And some of that has come on the back of margin expansions. The next one will come on the back of capex and capacity expansions. So I think, if you have a 5-year or 6-year horizon, this is still a great time to invest. If you have a 2-month horizon, I'm not the right person to ask.
No, we weren't asking for 2 months at all. I think you've given us a fair framework to work with in terms of those who are looking at meaningful investments in the market. Thank you, Deepak, very much for that. Always great having you on the show. You have a good rest of the day. Well, we need to take a very quick break, come back on the other side, and then we'll get you excerpts of our conversation with Prashant Jain on the market as it's very close to hitting the all-time high mark on the index.
Welcome back. Looks like we'll have to wait till tomorrow for the fresh all-time highs. Markets have given up a little bit. Mid-cap index has moved into the red, and the number of stocks that are declining have overtaken the number of stocks that are advancing. But that said, plenty moving and shaking around. I'll tell you what, Hormuz is standing by. He's going to run us through all the stocks that are moving around. Hormuz.
The last 10-15 minutes have made this list go a little awry, and even if there are movers, they are not moving on very substantial volumes in today's session. But the ones that are, one that stands out is Astec Life Sciences. We spoke about this in the morning, and since then it has extended its gains even more. 17% higher now on the stock. It's gained in 5 out of the last 6 sessions. The volumes in today's session for Astec are the highest since February of 2010. The highest volume in 15 years now for Astec in today's session. 53 lakh shares have been traded today. The 20-day average is not even 40,000 shares. So in comparison to that, we have had 53 lakh shares traded. And despite such a move, the stock still remains below its key moving averages, but it's nearing a very important level, which is the 50-day moving average, which is at 739. So still 10 rupees away from those. And as a result of this move, the stock has turned positive for the month of November after 4 consecutive months of losses. The second one on the list today is Universal Cables, and this stock has had 8 straight days of gains. It's cooled off ever so slightly from the highs of the day, but in this 8-day gaining streak, the stock is up around 40%, and this is the third instance in this 8-day winning streak where we have had more than 10 lakh shares traded in a single session. Here too, we've had well over 13 lakh shares that have been traded. The 20-day average is just around 2 lakh shares, and the stock is up 19% so far in 2025, making it the 5th straight year of positive returns. Now, the one that stands out though today is IEX, and that is making a move on some volumes in today's session. 4.5% higher on the stock. It's the second straight day of gains after a 4-day losing streak. The volumes today are the highest in the month of November that the stock has seen so far. We have had more than 1.5 crore shares that have been traded today. The 20-day average is just over 50 lakh shares, so it's 3x of its 20-day average, and the stock has just managed to cross its 50-day moving average of 141. So crossing key levels and on high volumes is IEX.
Okay, all right, Hormuz, thanks very much as always for all the buzzers of the day. Now, as promised, let's get you some market perspective. We caught up with Prashant Jain, the founder and chief investment officer at 3P Investment Managers, to get his sense on the prospects of the Indian economy. Now, Prashant says that this is the most optimistic he has felt on India in the last 35 years. Listen in.
In my 35 years of this industry, I feel the most optimistic about the next decade at least. And there are 3 or 4 very simple reasons. One, I think post-COVID, as remote working has gained acceptance, non-software service exports have grown exponentially. And I think India has very little competition in that space. There is no country in the world which offers, as Nilesh said in his opening remarks, the largest pool of English-speaking people, technically qualified, digitally skilled, the ecosystem of services, and at our price points. So I think what has happened, India's current account deficit has collapsed because of this. I think we are also getting a second shot at manufacturing. We missed it the first time. I think we'll do better this time. Manufacturing is a much bigger opportunity, and we are making good progress in our areas of weakness. So 25% of Apple phones are being assembled in India, and we know companies are going public that are now suppliers to the largest aeroplane manufacturers in the world, the Apples of the world. So I feel pretty confident about manufacturing as well. And finally, I think the government has never played a more supportive role than what it is doing today. So net, I feel quite optimistic. I think we should certainly grow between 6 to 7%. I think we have potential to grow beyond 7% as well. I compare India with its own past, and I feel optimistic about that. And so, I think 6 to 7% should not be difficult, but I think we are capable of growing faster. In 2000, blue-collar salary in Mumbai was 4,000 rupees a month. A starting software engineer's salary was about 30,000 rupees a month, 8 times that. Today, the both have converged. There are far more blue-collared in India than white-collared. Only 25% of Indians earn a fixed wage. That number globally is 50 to 75%. So I feel very optimistic about the rising purchasing power of blue-collared workers.
Well, Prashant also commented on the impact of selling by foreign investors and believes that it is inconsequential in the face of the fresh money coming into the market. Also, listen into the segments of the market he is bullish on.
The biggest supply of stock is coming from the primary market. Foreign selling hardly matters now. I mean, you are getting what, 500,000 crores of fresh money into the markets every year, including mutual funds and other formats. And that is the supply of new stock. I mean, let foreigners sell 50,000 crores, 1 lakh crores, it's okay. It is 10-20% of the supply. And I think that supply of new stock moderates itself to the demand. So I would say if flow goes down, the supply of new stock would also go down. So I think these markets are in a low volatility, lower moderate kind of returns. See, I think what has happened is this has been a narrative-driven market because pre-COVID there were 3 crore demat accounts. Today there are 20 crore demat accounts. And these 17 crore new demat accounts, they have no history. They had no accounts in the stock market before 2020. In 2020, the small mid caps fell the maximum. They fell 70%. The large caps fell 40%. Economic sensitive sectors fell a lot, and most PSUs were in economic sensitive sectors. So whatever fell the hardest has given the maximum returns. So 7 out of 10 investors have experienced these high returns, and they are wrongly extrapolating that, in my opinion. So I feel these themes have got there is business merit in those themes, but I think investment merit is clearly missing. So in my mind, clearly it is large caps over small mid caps. And look at it, in Nifty stocks, there is no supply of fresh stock. All the supply is in non-Nifty stocks. So I think that also favors large caps outperforming. I like large banks, I like insurance, I like software also. I am not so negative. Pharma is good, automobiles is good. I would be very cautious on consumer staples, white goods, brown goods, companies, even retail companies. But even tobacco, telecom, oil and gas, utilities, these are also sensibly valued here.
And referring to that term liquid oxygen, Prashant mentioned that flows won't let the market fall and supply of paper will not let the market rise.
Last commentary, we described the current states of markets as a dialogue which is attributed to Ajit. I don't know which movie it is from. कि इसको liquid oxygen में डाल दो. Liquid इसको जीने नहीं, oxygen इसको मरने नहीं देगी और liquid इसको जीने नहीं देगा. So I think these markets are like that. The rapid demand of or flow of money to equities is not letting it go down. And the rapid supply, equally large supply of IPOs is not letting it go up. I think I feel that in majority of these issues, investors over long periods will lose money. The expectations are likely to be unmet because we are seeing many weak quality, average quality companies with suspect fundamentals or not so great fundamentals going public at crazy valuations. So I think in a lot of these issues, long-term expectations will be not met. At the same time, on the positive, I think from an economy's perspective, it is positive because all kinds of entrepreneurs, large, small, good, bad, I mean, everyone is getting lots and lots of money. Something similar has happened many times in the past. 92 was like this, 2000 was like this, 2007 was like this.
All not good examples.
So it is not happening for the first time. And I mean, I would again come back to the same thing that investors have to be very discerning in where they are participating. Long-term outcomes, I think, will be very disappointing. I feel a lot of companies will have very weak supervision over time. Because if you look at some of these companies, the Ps will sell out in next 1, 2, 3 years. The promoter stakes are split over few individuals and they are in low to mid single digits. They will also cash out. So will these companies, all of them professionally governed companies, ultimately as they turn out, will they be well managed or no? I think that is another issue that one should consider when one is participating in these markets.
We'll take a snappy break, come back. Dealing room chatter on the other side. Nimesh is waiting for you.
SEBI.
Welcome back to Closing Bell. Well, as we speak, markets holding in the green. Nimesh standing by to tell us what he's picking up in D-Street chatter. Nimesh, we were almost there, but I think Friday to bante. What are you picking up in terms of flows?
Hi, Nigel. You know, as we speak, the mid-cap index is almost in the red. So it's like a two-kind market, right? The Nifty heading towards an all-time high, But if you ask a portfolio investor or any investor or trader, they are sulking. That's not making money for them. So that's the kind of a market we are. The large caps driven Nifty rally is clearly visible in the last couple of days, but that's not clearly spilling down to the broader markets. I'll explain a bit of broader market underperformance as well. But technically, I highlighted yesterday as well. 26,120 is a level to watch, and above that, you've seen a bit of a short covering rally today. Remember, the Nifty, the FIs are still short Nifty almost 88, 87%. So clearly, you will see further short covering rally if this, if this technical levels are sustained. And if market goes up from there. I guess the big trigger to watch will be the Indo-US tariff deal. There's a lot of chatter for the last couple of days. Given the Nifty move, there is a lot of hope. So need to see whether that comes out this weekend or before 27th of November. Flow again has turned slightly positive in the last couple of days. X of blocks as well. I'm getting a sense that there is a bit of buying interest back, especially in the large cap names. So Reliance is well bid, so is private bank stocks as well, and of course IT in the last couple of days. Now coming to the underperformance in the broader markets, one of the technical reason is I understand one large FI seems to be merging with another fund, so they have close to 38, 40 holdings and all liquid large cap names, mid cap names in that portfolio, and there they are either selling out or doing blocks as well. So maybe that explains a bit of underperformance in the broader market, but this Nifty rally seems to be clearly led by large cap names and a bit of short covering as well.
Oh, yes, absolutely. And one can only hope if those flows really come back in a sustainable manner. Some trickle we've seen from the FPIs this week, but let's see if it really builds. What about stocks, Nimesh? What's on your radar today?
Well, so the first stock on my list is GMR Power. That's been buzzing in today's market, good volumes as well. I understand the company is likely to raise funds by a preferential issue very soon, so that's something to watch out for. Some marquee HNIs, some large FIs are likely to put money in GMR Power pref issue, so that's the trigger there. The second stock is Bharat Forge. It has actually recovered this week from the recent lows and has done well as well. Largely, I understand the selling pressure from a leading long-only fund is largely over, and some bit of domestic buying has also emerged in Bharat Forge of late. The third stock is Polycab. It's marginally under pressure today, but I understand there are first rounds of selling from a leading domestic mutual fund in Polycab. Remember, the stock has done well of late, so a bit of profit booking from a domestic mutual fund there. The last one is Grasim. It's actually done nothing in the last few months, been consolidating. It was under pressure after that CEO exit, but at least a leading large HNI investor seems to be quite active and is accumulating Grasim at current levels.
Okay, all right. Got that, Nimesh. Thank you very much for all the details and all the buzz today from the street. Let's, however, now hop across to Nigel, figure out what's happening in the F&O market. Nigel, I guess the bulls will have to wait another day.
Well, that's right. It appears that's the scene, right? Because the Nifty, yes, it's holding up in the green. But today, actually, both the two batsmen that actually are supposed to lead it on the way up, they're underperforming. The tech index has, trading more or less flattish or thereabouts. And actually, if you look at that chart, the Nifty Bank as well is a relative underperformer. It's up only around 0.2%, while the Nifty is around 0.5% higher. Why have we moved up? Because two constituent actually of the Nifty, which are more than 20%, they have done very, very well. Fresh buying is what we're seeing on Reliance Industries. The stock is looking very, very strong. It made a 52-week high in today's trading session. And there's a big open interest built up out there as well. So fresh buying on Reliance Industries, fresh buying on HDFC Bank as well, has made up for the kind of underperformance that we've seen from the other large few stocks on the Nifty pack itself. Moving to the options data, well, the Nifty PCR, that's holding at around 1.4 or thereabouts. And that's moving gradually towards the upper end of the range because the put writers, they're feeling they are in the game. 26,100 put, well, the premium has come down to around 75 rupees. At the start of today's trading session, it was at around 160 rupees. The 26,200 put as well, the premium out there has come down to around 114 rupees, 110 rupees or thereabouts. At the start of today, it was around 215 rupees. So that's the kind of writing that we're seeing out there. At upper levels, it seems the call writing is now moving up. It's moved up to close to around the 26,250 call. The premium out there is at around 110 rupees or thereabouts. At the start of today, it was less than 55 rupees. So that's a big surge that is seen out there. A mix of activity. Those that bought yesterday, there was some buying, but today there is some writing that we're seeing at higher levels. In terms of individual stocks in focus, IEX, that stands out. A bit of a short covering bounce playing out on that one. I think tomorrow we'll be celebrating the fresh all-time highs. Back to you.
Okay, the bulls will definitely wait for that. They have waited long. So let's see if tomorrow we indeed get that. Amrish Balika joins us into the conversation. Amrish, good to have you in. What do you think? First, let's start with the easy question. All-time high, as early as maybe tomorrow, end the week in style?
Yeah, absolutely. In fact, for the last month and a half, I've been saying that possibly we should see a new high soon. But unfortunately, what's happening is just what you were discussing a while back. Most of the portfolios are in the negative, basically because the mid cap and small caps are really sulking. I mean, markets, Nifty is going one way, and the mid cap and small caps are going the different way. I just hope that once we see a new high, there could be some action back in the mid cap and the small caps, and we could see some amount of outperformance from there. And I think the trigger for all this should be that India-US treaty. So I think, I assume that should come by end of November, early December.
Sure. Okay, so let's get to your stock then. What do you have for us today?
Today's stock is Concor Container Corporation, which is a market leader in container terminal operator business with about 55% market share. And they operate about 66 terminals now. They have 17,500 wagons, 54,000 containers. They're increasing the capacity to about 70,000 containers and 100 terminals by 2028, which means upside scalability is decently high. And they've been increasing the value-added services like terminal handling and logistics solutions, which are margin accretive. The dedicated freight corridor is a big trigger for them, and this will fully be operational at JNPT by March 2026. I think this last connectivity is quite critical for Concor, and we should see that happening in the next 3 months. Q2 volumes grew about 11%. EBITDA margins were about 24.2%. And cement container transport, I think that's another big opportunity which I think Concor has grabbed. Overall, 13% revenue CAGR expected over the next 3 years. So EPS expectation for FY27 is about 23. And with this, my target price is 690.
Got it. All right, Ambrish, want to ask you a few more questions. For the time being, we'll take a short break, come back, continue our chat with Ambrish, and also we'll wind down the markets. Welcome back. Well, let's get back to Amrish Balega. Amrish, any view on the alcohol stocks today? I noticed Radico actually was doing quite well. You have Tilak Nagar as well as higher. Any view on these names? I'm just, wondering what's going to happen in Bihar. There's a prohibition that's in place out there, but the state finances are quite bad. I don't know whether or not they can take the bold decision because the women voters actually have supported the NDA in winning this election. That aside, what's the view on the alcohol stocks? What do you like?
Alcohol stocks like Tilak Nagar, again, after that buyout, I think we should see much better sort of revenues and margins going ahead. So Tilak Nagar, I think, should be bought even at the current levels.
Okay. All right. And any others? Would that be the pick from the pack or you're bullish on the theme?
No, that's the pick from the pack right now. Although overall on the space I'm bullish, but I think this is one pick which should give decent returns over the next at least 6 to 8 months.
Interesting. All right. What about some of these newly listed companies, Amrish? What's the view? Grow, stop growing? Lenskart, in fact, had a pretty decent listing for the kind of valuations that they did come in at. You have Physics Wala actually that's come off the top. And, the other one, Tenneco, a lot of interest, was up 20% yesterday. Today, it's given back a little bit. Any view on any of these? Have you had a look?
I think most of them were decently expensive, whether you talk of Grow or Lenskart or even Physics Wala. I think the move which we saw in some of them, especially Grow, we saw nearly 100% sort of a move. I think that had to do more with technicals because of that low float. A lot of short squeeze that happened. We had seen a lot of auctions happening, because of which we had seen that move. But then once the anchor, investors start selling, possibly after a month, and at the same time, we should remember that they had placed a lot of shares in the private market to HNI investors. All through. I think the last deal which happened must have been about at 134, 135 just before the IPO, and post that the IPO came at 100. So I think there could be a lot of selling coming in from, that space also, but that's going to take time because there's a 6-month lock-in for those investors. But then, end of the day, it's the valuation finally which will come to play, and that's quite expensive. So I see Grow again going back to those levels, possibly of about 115, 120. I really don't see it worthwhile anything beyond that.
Okay. So need to perhaps watch this with some caution. Take that point, Amrish. NBFCs. Today, actually, a couple of these stocks are doing very well. Bajaj Finance is back up to 2.5%. M&M Finance surging this afternoon to 2.5% up as well. So what do you think of some of the frontline names on Shriram Finance? The market is still awaiting. Everyone keeps saying there may be a deal. So what would let's say your pecking order, your preference order be if you want to add 2 to 3 NBFCs to the portfolio?
One is Bajaj Finance, clearly. Because of the way the consumption is going. We have seen post-September, the sort of a consumption boom. That's going to help most of these NBFCs, which are basically retail-focused. They would benefit quite a lot, at least for the next 1 or 2 quarters. So from that point of view, Bajaj surely should be on the buy list.
And Saman Capital?
I would possibly wait a while because there are those controversies. So I would wait a while before looking at that.
I think a couple of stocks, that deserve mention. You had Aztec Life. The stock is now up 20%. Bazooka move is what we're seeing out there. Anupam Rasayan, these stocks are still gaining, but they've taken a bit of a leg up. And I think Piramal Finance, that's a newly listed company. In all probability, tomorrow it comes out of the trade to trade, because that cool-off period is over. So I think that's the reason why that stock now is locked in upper circuit. And there are pending buy orders on Piramal Finance as well. Just thought we'll highlight a few of these names that are moving quite well. And from the tech pack, actually, eClerx is moving pretty well. It's moved up a little bit as well in the last few minutes. So not so bad, actually, though I've been saying that portfolios are not feeling like those all-time highs. Select stocks are doing a jig of their own. Well, Amrish, appreciate you joining in and giving us the thoughts. I think it's just around 90 seconds odd. So time to wind down the markets for today's trading session. The Nifty goes home with a gain of close to 150 points. No mean feat, pretty good. But getting into the final hour of trade, you thought that this was it, that we're going to be making those fresh all-time highs. However, that wasn't to be. HDFC Bank and Reliance Industries, those big boys, they did the heavy lifting in today's trading session. Both of them up close to around 1.5% and doing very, very well. Reliance in particular, well, that's the one that contributed the most to these 150 points on the upside. What is the problem then? The tech index, that was more or less flattish today, which is not bad after seeing a 3% gain in yesterday's trading session. Ended as flat as can be. And the Nifty bank, that ended with a gain of only around 0.2%. From the broader markets, a lot of stocks actually were moving around. You had Tilak Nagar Industries that was up close to 3.5%. On large volumes, you had e-clerks as well that did pretty well. Aztec Life is another stock, that in fact did very, very well in today's trading session, was up 20%. Another one that's coming up on the list is UFO Movies, up 10%. Dredging was locked up 10% in the first few minutes of trade itself. And Anand Rathi shares as well, 6.5% up. So plenty of stocks should be. It did well in a market that was a little bit tepid actually, because the number of stocks declining still were more than the number of stocks advancing.
Absolutely. I mean, you do have a lot of those mid-cap high flyers, but on the losing side, must take in account the profit taking we've seen again on Grow. 8% down on Grow. Today even PhysicsWallah came in for some selling. Orkla India, another recent listing, down about 4.5%. Some of these new listings cooling off. Hyundai Motor, Biocon, these were some of the other names. Nazara was down 4%. So these were some of the other names. Today's new listing, Fujiyama, by the way, has ended down 9% as well. So it wasn't a great day for the recent entrants on the street. Some caution in that side of the market. Well, the bell has gone, and that's where we take your leave on this edition of Closing Bell. But keep it with us, because Markets Forward will take the action ahead.
Indian markets end off their intraday peaks. Broader indices underperformed. The Sensex and the Nifty, however, scaled 52-week highs, remain just short of record levels. Mid-caps and the Nifty bank indices post gains.
Nvidia reports record sales and profits in the third quarter. Growth outlook also beats estimates, soothing frayed nerves on Wall Street and in other markets around the world. Dispels fears over AI valuations, at least for now.
M&M targets organic growth of 15 to 40% across their businesses till 2030, aims to be the world's fastest growing SUV brand and top light commercial vehicle brand. Mahindra Holidays invests 1,000 crore rupees to foray into leisure hospitality. The Great Indian Bull Run well and truly on. You're watching us here on Markets Forward, your go-to show where we tell you all the key data points that took place today and also gear you up for the trading day tomorrow. 25,200, so close yet so far from the all-time high on our frontline indices. I'm Mangala Malu, with me Surbhi. Surbhi, what a day it was.
Oh, absolutely. Tantalizing, teasing. You can use all kinds of objectives because we're almost there, 30 points away. That's what it was. But then some profit-taking kind of set in. But nonetheless, the market had a fair amount of momentum. And what was interesting was that while other global markets came roaring back, thanks to Nvidia, it's not like India was completely letting itself down. We held our own. A lot of the gains were intact. But yes, it was more a large cap day than a mid cap day. So we'll talk a lot about these trends as we go forward, the constituents of today's rally as well. But all in all, not a bad session, one could say, Mangalam.
Not a bad session, barring the last hour where we saw some profit taking, understandable because of the overheatedness of the market itself. But if there was a phrase to explain, it was basically all guns blazing. Why do we say that? The smooth shifting of baton that took place over the last few trading sessions, if you look at it, it was the Nifty Bank, which was doing well, all-time high yesterday as well. Took a bit of a backseat before coming back in the second half. And yesterday, what was it that supported the frontline index? It was the IT index. And today, the Nifty Bank as well as the IT index, both of them took a bit of a breather. It was the third wheel. It was Reliance. Just look at the big move that we saw in Reliance, ended at the higher end of today's trading session. So this smooth passage of the baton ensured that the Nifty run continued, irrespective of what was taking place in the broader end of the market. And on that itself, let's tell you what we have on the show today for you. We start obviously with the top movers and shakers of the day today, more decliners than advancers in the trading session by the end of it all. Mahindra outlines an ambitious growth roadmap at the Investors' Day. Adani Enterprises, they win the bid to acquire debt-ridden JP Associates, and Nvidia quells AI concerns after posting a strong set of earnings in their third quarter. And last but not least, we prepare you for trade tomorrow, delve into the key market events you need to watch out for. So, first up, let's go straight across to Hormaz, who has all the top movers and shakers.
It was a fantastic day indeed, although we did not reach those record high levels, but no reason to complain whatsoever, and led predominantly by the financials. The Bajaj twins were in charge on the index today. M&M Financial had a good day. HDFC Bank contributed to the gains as well. So financials were up and running in today's session, but what did not have a very good day were the new listings, the new kids on the block. Grow had a very forgettable day, another 8% after that 10% circuit in the previous day. Physics Wala had a very sharp intraday recovery from the lows that it made and managed to end in the green. So it was a 17% recovery from the lows of the day. Tenco Clean also saw some profit booking, and Lenskart ending 3.5% lower in today's session. PSU Banks was another pocket that was sulking in today's session. Every constituent of the PSU Bank index ended lower in today's session, be it the larger ones or the smaller ones, losses of anywhere between 1.5% to 3%. Stocks that were moving on the back of strong volumes in today's session, Radico Khaitan was one of them. Natco Pharma and IEX made up in the list of names moving on strong volumes with a 4.5% move. And lastly, stocks that ended at a 52-week high in today's session. Hitachi Energy continues to move higher. Add to the two-wheeler names, Eicher Motors and Hero MotoCorp. Hero, of course, getting a second upgrade in as many days. And AI Engineering too had a good day, ending at a 52-week high today.
Okay, all right, Hormaz, thanks very much. So plenty of buzzers, movers and shakers on the street today. Let's get going then. Mahindra & Mahindra hosted its Investor Day, where the company outlined its ambitious future roadmap. The conglomerate is targeting organic growth of 15 to 40% across its businesses by 2030. Sudarshan joins in to lay down M&M's expansive growth blueprint. Sud.
So first I'll talk about Mahindra Group. It's holding the biggest ever Investor Day, where all the 12 group CEOs are participating, and ahead of the investor day, these group companies have released details on the exchanges giving the very strong outlook over the next few years. So as a group, over FY22 to 25, the organic growth was 25%. Now going forward for FY26 to 30, now the target is in the range of 15% on the lower side, and on the upside, it's as high as 40%. Now coming to revenue outlook, where the group has given for 1 decade, that is from FY20 to FY30. For SUV and LCV, the growth target is 8 times. Tractor, 3 times. Truck and bus, which used to be earlier known as SML Isuzu, 6 times. And for Mahindra Last Mile Mobility, the growth target is 6 times. Coming to the market share, for LCV less than 3.5 tons, in FY25, market share was 51.7. Now, in FY26, it's seen rising to 54.1%. For SUV, in FY25, market share was 22.7%. That can increase to more than 26%, that is to 26.4%. For tractor outlook, the group companies have raised the outlook till FY30. So earlier, tractor industry outlook for FY25 to 30 was 7% CAGR. Now it's been increased to 9%, and demand would be raised by the company. Group is seeing demand for higher horsepower tractors, that is in the range of 40 to 50. They've also mentioned few aspirations. For SUV, they want to be world's fastest growing SUV brand. LCV, they want to be #1 brand across segments and applications. For tractor, they want to transform lives of farmers globally by democratizing technology. For truck and bus, they want to be amongst top 3 in India's ILCV trucks, that is basically school bus and truck, focused mainly in higher commercial vehicles. In EV, they want to be #1 in eCV company with 1 million EVs on road by 2031. For M&M Finance, they want to be amongst most trusted financial services provider for Bharat. So it means they want to focus on rural area, and till FY30, they see 5 times AUM growth. For Tech Mahindra, turnaround is expected to be completed by FY27. On a similar trend, they have a huge target for Mahindra Holidays and Mahindra Life also. So big investor day and a big outlook by Mahindra Group.
Indeed, take that point, Sudarshan. Big investor day, big outlook as well. Good time to welcome our guests. Amrish Balika joins in. Along with him is Ruchit Jain as well. Amrish, coming to you first. What do you make of all these projections that the Mahindra Group has made for growth across its companies, and in this wide ranged names that we have in this, in the conglomerate, which is the most investable idea right now?
See, there are 2 most investable ideas in that group. One here is a flagship, Mahindra & Mahindra. Looking at the way, the SUV market is going, that's the major market right now, and Mahindra is a leader there. And even in EVs, the sort of vehicles they have launched, I think they would be the leaders even going ahead. So Mahindra & Mahindra is clearly one of them. And the second one is Mahindra Holidays, which again I've been recommending for a while. I think that's one stock which can, in fact, become a multi-bagger going ahead. Because they are clearly doubling the number of keys they have, and now they are setting up a new leisure subsidiary. But I think the most important thing to be looked out here is that Mahindra Holidays has completed 25 years. So the first set of subscribers who had in fact paid for the capex done in the last 25 years, they would be moving out one by one, and those assets will become free. I think market is yet to look at this side of the trigger. I think this should play out at least over the next 2 to 3 years.
Okay, all right. Got that point, Amrish. Do stay on. We'll have more questions for you in just a bit. But let's also address what was the biggest global story of the day. Chip maker Nvidia alleviated fears of AI spending turning into a bubble with a strong third-quarter performance that surpassed Wall Street's expectations. The world's most valuable company's guidance for fourth-quarter sales was also stronger than what the street had factored in. Hormaz is here with more details. Hormaz.
Too good to be true. That's not possible. Mano ya na mano. You can use all of these phrases when you look at Nvidia's results this quarter, but the numbers don't lie. It is what it is. Now, yet another blockbuster quarter from the world's most valuable company, and markets across the globe are breathing a sigh of relief. Now, we all know Nvidia's results were a beat on expectations, but that's not it. Here's a bigger picture. Now, for the first 9 months of the year, Nvidia has reported sales of close to $150 billion, profits of close to $80 billion. And for the fourth quarter, it has made a projection of $65 billion in sales, despite the issues in China. Now, if this guidance holds, the company could well end the year with sales of over $200 billion and profits in excess of $100 billion. But how big is too big? Here are some illustrations to show how big Nvidia actually is. For the first 9 months of this fiscal, Nvidia's profit is $77 billion. Now compare that to the sales reported by its closest competitors, Intel and AMD, for the same time frame. That is close to $60 billion. This shows that Nvidia is earning more than two of its closest rivals put together are managing to sell. Now that is some statement. Now, more than the results, the global markets are also breathing a sigh of relief from Jensen Huang's remarks. He mentioned on the earnings call about the AI bubble, saying that from their vantage point, they see something very different. And when the CEO of the world's largest AI chip supplier says all is well, the market surely takes note of it. Nvidia recently hit $5 trillion in market cap. You heard that right, $5 trillion. Now, the journey from 4 trillion to 5 trillion happened very quickly. It took only 79 trading sessions. We hit 2 trillion in Feb of 24, went to 3 trillion in June of 24. Then we had a bit of a sell-off. Then we hit 4 trillion in July of this year. And then we hit $5 trillion very recently. Now, the last time when the stock had hit $4 trillion, we tried analyzing what if Nvidia was a country. Today, we tell you what if Nvidia was a stock market on its own. After a brief post-listings, post-5 trillion slump, the market cap is now below that $5 trillion mark. But even at $4.5 trillion, Nvidia is only smaller than the stock markets of China, Japan, Hong Kong, India, and of course, the United States. Here's another illustration of how big Nvidia is. Out of the 13 quarters of the fourth quarter of FY23, Nvidia had sales of around $6.5 billion. Now, for the current ongoing fourth quarter of FY26, the sales projection is $65 billion. That's a 10x jump in just 3 years. The exponential growth shows up in the stock price as well. Between 2020 and 2024, Nvidia stock has doubled or even tripled in value in 4 out of the 5 years. Even this year, the stock has more than doubled from its tariff lows, but such was the damage that even today, the year-to-date gain is only 35%. CLSA has retained its high conviction outperform rating on the stock with a target of $270. Despite this surge, only 1 out of the 79 analysts that track the stock has a sell rating on it. If CLSA's target is higher, there are targets even higher, as high as $350 on Nvidia. So in this battle of David versus Goliath, the Goliath keeps getting bigger and better, and the Davids around it are also cheering the results with share price moves of their own. Nvidia has categorically stated that the AI boom is here to stay, and it wants to have the largest share of that pie, one chip at a time.
Oh, and it is reigning supreme. And how Horma's very, very interesting analysis there. Those are just absolutely mind-boggling numbers, right? When you see what has happened in a matter of just 2-3 years. So quite phenomenal. Thank you for that. Amrish, now we can't discuss Nvidia. We don't have, that's not what we are doing here, but we can discuss NetWeb, right? And that's been a stock that's been seen as a, Nvidia play here in India. They're one of the suppliers, but the stock has also rallied a lot. It's off its all-time high. What's your sense on it?
As long as we have the AI rally, possibly we could also see NetWeb also moving up. Just about 2-3 days back, there was a fear of a crack because of NVIDIA earnings. But then with such encouraging earnings, I think this fear will shift for at least another quarter more. So I think come February, again, the same issues will again come into the market. So from a short-term angle, yes, I think NetWeb can move up more from here, maybe levels of about 3,800, 4,000.
All right, that's the point. Rojit, coming to you, Reliance is, the top contributor. We've seen the stock move a bit. It's at a 52-week high, but, not quite there at the all-time high as well. What's your view on this stock, and where do you think it goes from here? Was this up move today just an aberration or maybe the start of a move?
I think it seems to be more of a continuation of the uptrend. The stock has seen a good up move from that 1360, which were the recent swing highs. And no, if you look at the previous swing high on 9th of July, the stock had faced a resistance around 1545. And no, today it has closed above that previous swing high resistance. So this clearly indicates a continuation of the uptrend. And if you look at today's entire day's volume, they were better than what we usually see on a daily basis. So a breakout above previous swing high supported by high volumes is just a sign that we should see a continuation of the upward move. So I think 1600, which were 1590, 1600, which were all-time highs, that should be seen quite soon in Reliance Industries.
To say the same of another big heavyweight, HDFC Bank, that too hasn't set the street on fire with its move. It's been the other parts of the Nifty Bank which have been doing well. HDFC Bank today woke up. It was up around 1.5%, ended at the higher end of today's trading range. Do you see a similar pattern for HDFC Bank as well?
I think if you compare this entire up move in the stocks such as Reliance, HDFC Bank, along with the markets, then I think this leg of up move has been led by these heavyweights itself. If you look at Nifty returns versus the mid cap on the small caps also, then in this month itself, in month of November, Nifty is up by 2%, Bank Nifty is up by almost 3%, while the small cap is down by 2%. So clear there has been a divergence in the mid and the small cap stocks and the mid cap and the large caps in this month. And I think that trend is likely to continue at least towards the end of this month. So the large caps leadership, if we see, then stocks such as Reliance Industries, HDFC Bank, these are few names where a clear outperformance is there. So even HDFC Bank on charts looks good. The stock has seen a good base formation around its 50 DEM of 985, 990. Until that is intact, we expect higher levels around 1040, 1050. So short-term trading opportunities, if one is looking, then it's best to look opportunities within the large cap space itself.
Okay. All right, gentlemen. Thank you very much for joining in and giving us all your perspective and views on the market and stocks. We have to take a very quick break. Come back on the other side and we'll get you the top corporate voices of the day as well as the events to watch tomorrow. Welcome back. As promised, let's get you all the corporate action of the day. It was a muted D-Street debut for Fujiyama Power. The stock listed at a 4% discount to the issue price. Chairman Pawan Kumar told us that the company aims to cut debt and interest costs by 50%. He added that the new Ratlam facility will double its overall capacity.
And the giant Wonderla Holidays has, they expect 7 to 8 lakh visitors in a year in its new Chennai park, which opens on December 2nd. This will grow to about 1 million by the third year of operations. The management told CNBC-TV18 it could reach break-even in the first to second year when it comes to the EBITDA level, and payback period would be over the next 6 to 7 years. They're also in talks with several state governments, including the likes of Mumbai, Maharashtra, and Delhi, Gurgaon, for setting up parks in those major cities.
Founder of Quant Mutual Fund, Sandeep Tandon, told CNBC-TV18 that several factors now support a strong pullback rally in the market, and he even expects the Nifty and other frontline indices to hit fresh all-time highs as early as December. Tandon added that he sees opportunities in neglected sectors such as insurance, NBFCs, and some private sector banks.
All right, and as always, before we wrap up, we'll get you all the key market events to watch out for tomorrow. Upasana Bhatt standing by with the events.
Well, first up, let us look at the global economic cues. US will be reporting its Fed balance sheet that will be out tomorrow, Japan core CPI data, and back home, that is in India, S&P global manufacturing PMI data will be out tomorrow. So let us look at the key stocks that will be on our radar on the back of corporate action. Stocks like Oil India, IRCTC, MRF, Sonata Software, all these stocks will trade ex-dividend tomorrow, so they will be in focus. Next up is Kotak Mahindra Bank. Board will consider proposal of stock split. Now on the IPO front, Sudeep Pharma opens for subscription while Excel Soft Technologies will close for subscription. And furthermore, in terms of listing, Capillary Technologies will be listing on exchanges tomorrow, so we'll be keeping an eye out on that as well. Now, let us look at some of the key important events tomorrow, such as PM Modi to attend G20 summit in South Africa. Finance Minister Nirmala Sitharaman pre-budget consultation with industry stakeholders in sectors like energy and infra will be taking place tomorrow morning, so we'll be tracking that as well. And lastly, Piyush Goyal will be visiting Israel, and the talks on trade, technology and investment is what is being discussed there. So all in all, looks like quite an eventful day tomorrow.
Okay, all right, Upasana, we will track all of those events very, very carefully. Thank you for getting us the latest. Well, with that, it's time for Mangalam and me to take your leave. But before we go, Mangalam, now, you know, he's a veteran in the market, right? Yep. He's someone who has seen so many market cycles, usually someone who's seen as a bit of a conservative fund manager, someone who, you know, checks the numbers very, very carefully. I'm talking about Prashant Jain. And guess what? He's turned positive on the market, or he says he's the most positive on the market in 35 years.
Wow, and the last 35 years, if something is to go by, it's been a big, big rally that we've seen in the Indian markets. And if he's more positive now, where do we go from here? Well, let's hear out Prashant Jain. What we'll do is take your leave and you stay tuned to CNBC-TV18. More news and updates follow.
I compare India with its own past, and I feel optimistic about that. And so, I mean, I think 6 to 7% should not be difficult. But I think we are capable of growing faster. In 2000, blue-collar salary in Mumbai was 4,000 rupees a month. A starting software engineer salary was about 30,000 rupees a month, 8 times that. Today, the both have converged. There are far more blue-collared in India than white-collared. Only 25% of Indians earn a fixed wage. That number globally is 50 to 75%. So I feel very optimistic about the rising purchasing power of blue-collared workers. So I feel these themes have got there is business merit in those themes, but I think investment merit is clearly missing. So in my mind, clearly it is large caps over small mid caps. And look at it. In Nifty stocks, there is no supply of fresh stock. All the supply is in non-Nifty stocks. So I think that also favors large caps outperforming. I like large banks, I like insurance, I like software also. I am not so negative. Pharma is good, automobiles is good. I would be very cautious on consumer staples, white goods, brown goods, companies, even retail companies. But even tobacco, telecom, oil and gas, utilities, these are also sensibly valued here.
welcome to Business 360. I'm Arundhati Ramnan, and here are the headlines that we're tracking for you this evening. Nifty hits a 52-week high and comes within 30 points of the record high. Sensex gains nearly 500 points. Nifty Bank and Mid-Cap Index hit a record high before giving up some gains in late trade. Nvidia reports record sales and profit in the third quarter. Growth outlook also beats estimates, soothing frayed nerves on Wall Street, dispels fears over AI valuation, at least for now. United States approves the possible sale of Javelin missiles and Excalibur projectiles to India worth nearly $93 million. This comes just days after India signed a deal to buy cooking gas from the US, accounting for 10% of LPG imports in 2026. M&M targets organic growth of 15 to 40% across businesses till 2030, aims to be the world's fastest growing SUV brand and the top light commercial vehicle brand. Mahindra Holidays invests 1,000 crore rupees to foray into leisure hospitality. Starbucks CEO Brian Niccol says India sits at the heart of their global strategy as it brews its 500th store in the country in partnership with the Tatas, highlighting that US tariffs has not impacted sourcing as India has a localized supply chain. That's an exclusive. Supreme Court refuses to prescribe timelines for governors and the President of India to clear bills passed by state legislatures, signals limited judicial scrutiny for prolonged, unexplained and indefinite delay in granting assent to bills.
मैं नीतीश कुमार सत्यनिष्ठा से प्रतिज्ञान करता हूं
JDU Supremo Nitish Kumar takes oath as the Chief Minister of Bihar for the 10th time after NDA's landslide victory. 26 other MLAs, including BJP Samrat Chaudhary and Vijay Kumar Sinha, sworn in as well. Prime Minister Modi, Home Minister Shah and top NDA leaders attend the ceremony. Any peace plan on Ukraine must take Europe and Kiev on board, say EU officials. This after US and Russian officials draft a peace plan which will require Ukraine to give up some territory and downsize its military. 28 people were killed in Ukraine after Russian strikes yesterday. At least 32 killed in Gaza in 24 hours in Israel's latest violation of the US-brokered ceasefire. Dozens injured as per Gaza's media office. Over 280 have been killed and more than 650 injured in nearly 400 Israeli violations since the October 10th ceasefire. Those were the headlines that we're tracking for you this evening, but straight to the day's market action. Sensex and Nifty hit 52-week highs after a steady session on Dalal Street. In fact, the Nifty was just 30 points away from its record high during intraday trade. Both indices did give up some gains in late trade. Nifty Bank and the Mid-Cap Index hit a new record high before seeing some profit booking. The Mid-Cap underperformance kept the market breadth in favor of declines. Surbi Upadhyay is here with all of the action from Dalal Street. Surbi?
Let's dissect what really transpired today. So today, if you talk about the leading sectors, then defense, infra, oil and gas for sure, thanks to Reliance, capital markets, autos, and even banks. Banks didn't lead from the front, but they did chip in, and I'll get to more of this in just a bit. The lagging sectors today, real estate, pharma, healthcare, and PSU banks. Let's see how this translates into actual Nifty stocks. So Nifty gainers, Reliance Industries, like I'm saying, and the other heavy hitter, HDFC Bank, contributed quite nicely. Axis Bank was up and about, and auto stocks had a pretty good session, specifically some of the two-wheeler names like Eicher Motors as well as Bajaj Auto. Both those stocks up between 1 and Eicher, the Nifty winner, actually going up to almost 3% gains. The losers then, some consumer stocks like Asian Paints, Titan seeing profit taking. Lever was also down, and some of the tech names that did very well yesterday, they cooled off today. So names like Infosys and HCL Tech, to name a few. Now let's come to the mid-cap part of the market, and that was the only grudge, so to speak. Because mid-caps underperformed large caps, the index was more or less flat, and the advance decline ratio was also negative, more declining stocks than advancing stocks in the market today. So let's talk about the movers, the big listings or the recent listings. Today was a day to come down to gravity. So Growth, second day running, managed to see a cut, 6-7% down on Growth. Physicswala was also slightly lower. Hyundai had a bit of a rough session, 3% down on Hyundai Motor. Biocon, and like I said, IT, not just large cap, but even mid-cap IT, which was sizzling yesterday. Today was some profit taking on names like L&T Technologies. There was Coforge and Intellect Design. Let's talk about the gainers on the upside. Today, Mahindra & Mahindra, the group had its investor day. So some of those group stocks were really surging. M&M Financial, for instance, 4-5% higher. Mahindra Holidays, which is also getting into the leisure and hospitality space now. That stock was up about 3-3.5% as well. Beyond that, there was Radico, Khaitan, Network surging thanks to the strong performance from NVIDIA. And then some other names like Canada, Robeco, AMC, 9% higher on this one. And even IEX had a good session, 4% up.
Right, Sabri, many thanks for those details. Now, chip maker NVIDIA quelled fears of an AI spending bubble with a strong third-quarter performance that surpassed Wall Street's expectations. Net income rose 65%, riding on the back of a 66% year-on-year increase in its crucial business data center sales. The world's most valuable company's guidance for the fourth quarter sales was also stronger than what the street had factored in. Hormaz Fatakia is here with all of those details. Hormaz?
Too good to be true. That's not possible. Mano ya na mano. You can use all of these phrases when you look at NVIDIA's results this quarter, but the numbers don't lie. It is what it is. Now, yet another blockbuster quarter from the world's most valuable company, and markets across the globe are breathing a sigh of relief. Now, we all know NVIDIA's results were a beat on expectations, but that's not it. Here's a bigger picture. Now, for the first 9 months of the year, NVIDIA has reported sales of close to $150 billion, profits of close to $80 billion, and for the fourth quarter it has made a projection of $65 billion in sales despite the issues in China. Now, if this guidance holds, the company could well end the year with sales of over $200 billion and profits in excess of $100 billion. But how big is too big? Here are some illustrations to show how big NVIDIA actually is. For the first 9 months of this fiscal, NVIDIA's profit is $77 billion. Now compare that to the sales reported by its closest competitors, Intel and AMD, for the same time frame. That is close to $60 billion. This shows that NVIDIA is earning more than two of its closest rivals put together are managing to sell. Now that is some statement. Now, more than the results, the global markets are also breathing a sigh of relief from Jensen Huang's remarks. He mentioned on the earnings call about the AI bubble, saying that from their vantage point, they see something very different. And when the CEO of the world's largest AI chip supplier says all is well, the market surely takes note of it. NVIDIA recently hit $5 trillion in market cap. You heard that right, $5 trillion. Now, the journey from 4 trillion to 5 trillion happened very quickly. It took only 79 trading sessions. We hit 2 trillion in Feb of 24, went to 3 trillion in June of 24. Then we had a bit of a sell-off. Then we hit 4 trillion in July of this year. And then we hit $5 trillion very recently. Now, the last time when the stock had hit $4 trillion, we tried analyzing what if NVIDIA was a country. Today, we tell you what if NVIDIA was a stock market on its own. After a brief post-listing, post-5 trillion slump, the market cap is now below that $5 trillion mark. But even at 4.5 trillion, NVIDIA is only smaller than the stock markets of China, Japan, Hong Kong, India, and of course the United States. Here's another illustration of how big NVIDIA is. Out of the 13 quarters at the fourth quarter of FY23, NVIDIA had sales of around $6.5 billion. Now, for the current ongoing fourth quarter of FY26, the sales projection is $65 billion. That's a 10x jump in just 3 years. The exponential growth shows up in the stock price as well. Between 2020 and 2024, NVIDIA stock has doubled or even tripled in value in 4 out of the 5 years. Even this year, the stock has more than doubled from its tariff lows, but such was the damage that even today, the year-to-date gain is only 35%. CLSA has retained its high conviction outperform rating on the stock with a target of $270. Despite this surge, only 1 out of the 79 analysts that track the stock has a sell rating on it. If CLSA's target is higher, there are targets even higher, as high as $350 on NVIDIA. So in this battle of David versus Goliath, the Goliath keeps getting bigger and better, and the Davids around it are also cheering the results with share price moves of their own. NVIDIA has categorically stated that the AI boom is here to stay, and it wants to have the largest share of that pie, one chip at a time.
So in NVIDIA, they're getting bigger and better. Thank you, Harmas, for those details. Now, the United States approved the possible sale of Javelin missiles and Excalibur projectiles worth nearly $93 million to India. The Excalibur deal is for $47 million and the Javelin deal is for $46 million. The U.S. said that the package includes 216 Excalibur artillery rounds and 100 FGM-148 Javelin missiles. This comes after India signed a deal to buy cooking gas, indicating a potential easing of trade tensions. Federal Reserve officials were at odds during their October meeting over cutting interest rates. According to written records of the meetings, the officials were also divided on whether the central bank should cut rates next month. The minutes indicated that most participants felt that further rate cuts were warranted, but not necessarily in December. However, participants does not denote voters. There are 19 participants at the meeting, but only 12 vote. And speaking of the Fed, U.S. President Donald Trump said that he would love to fire Jerome Powell. Addressing the U.S.-Saudi Investment Forum in Washington, the president also said that Treasury Secretary Scott Bessent needs to work on Powell to quickly lower rates, indicating that the Treasury Secretary's job depends on it.
Mortgage rates are down despite the Fed. I mean, Scott, you got to work on this guy. He's got some real mental problems. No, he's something wrong with him. It's just sweet. I'll be honest, I'd love to fire his ass. He should be fired. Guy's grossly incompetent, and he should be sued for spending $4 billion to build a little building. I'm building a ballroom that's going to cost a tiny fraction of that, and it's bigger than the whole thing put together. You got to work on him, Scott. The only thing Scott's blowing it on is the Fed. Because the Fed, the rates are too high, Scott. And if you don't get it fixed fast, I'm going to fire your ass, okay?
Shares of pharma major Zydus Life Sciences rose as the company onboarded 3 investment bankers for a 5,000 crore rupee fundraise. As per a Money Control report, they are Jefferies, JP Morgan and IIFL Capital. Money Control has also reported that the funds will be raised via qualified institutional placement, which is likely to be launched at the start of 2026. Infosys' 18,000 crore rupee share buyback opened today, making it the company's largest buyback to date. The buyback, priced at 1,800 rupees per share, will close on November 26th. Infosys aims to repurchase 10 crore fully paid-up equity shares. The company said the buyback is intended to return surplus funds to shareholders in line with its capital allocation policy. Promoters who hold just over 13% will not participate in the buyback. Investors continued to book profits in newly listed broking firm Grow, which fell 9% today. The stock, which had rallied nearly 90% since listing, has now slipped 18% in just 2 sessions. This amid stretched valuations and shorting by traders. The stock's market capitalization now stands at 98,000 crore rupees. The Mahindra Group hosted its annual Investor Day. The conglomerate is targeting organic growth of 15 to 40% across businesses till 2030. The group aims to be the world's fastest growing SUV brand and the top light commercial vehicle brand. Mahindra Holidays is foraying into leisure hospitality by creating a wholly owned subsidiary with an investment of 1,000 crore rupees. CNBC-TV18 spoke to the CEOs of all Mahindra Group companies, and that special show will be broadcast at 6:30 a.m. tomorrow. Representatives from the tourism and hospitality sector are with Finance Minister Nirmala Sitharaman for pre-budget consultations. Sources say the sector has sought industry status, which has been a long-pending budget demand. They have also sought clarity on GST treatment, especially on how rates apply to room tariffs amid dynamic pricing. Single window clearance system for the hospitality sector is also one of the key demands. Starbucks CEO Brian Niccol has said that India is one of its fastest growing markets as it gears up to open its 500th store in the country. In an exclusive interview with CNBC-TV18, Niccol outlined their India growth plans. He said that they were in India building a coffee culture for the long term. Starbucks runs its India operations through a 50-50 venture with Tata Consumer Products. On that note, it is time for us to head into a short break. But coming up next, Supreme Court refuses to prescribe timelines for governors and the President of India to clear bills passed by state legislatures. More details on the other side. Stay tuned. Welcome back. The big national story today. JDU Supremo Nitish Kumar took oath as Bihar's Chief Minister for the 10th time after a landslide NDA victory in the assembly elections. The 74-year-old is now India's 8th longest-serving Chief Minister. 26 legislators, including BJP Samrat Chaudhary and Vijay Sinha, took oath as well. The contours of the new cabinet are yet to be formalized. A majority of the MLAs who took oath along with Nitish were from the BJP. Prime Minister Narendra Modi, Home Minister Amit Shah and top NDA leaders attended the oath ceremony at Patna's Gandhi Maidan. The Supreme Court has refused to prescribe timelines for governors and the President of India to clear bills passed by state legislatures. But the top court signaled limited judicial scrutiny for prolonged, unexplained and indefinite delay in granting assent to bills. This comes after a rare presidential reference was made to the court over its verdict in April, which imposed a 3-month deadline on dealing with bills passed by state assemblies. Ashmit Kumar is here with more on the court action. Ashmit, explain the Supreme Court's observations today and its implications.
Well, first up, it was in the month of April that a bench of the Apex Court itself had granted this order, had directed for a 3-month deadline to be imposed on the President as well as the Governor. It is in response to that we had a presidential reference, which is in the nature of a question. The President is asking a question from the Supreme Court that can such a deadline be imposed by the Supreme Court on the President who happens to be a constitutional office bearer. Now, that was the question, among others, that was being dealt with by the Apex Court. And then, as a part of an opinion, today's the findings that the Supreme Court has given is an opinion. It is not binding on the government. It is only, it has a guiding force, but nonetheless, coming from a bench of the Supreme Court of no less than 5 judges, it does carry a significant amount of weight. Now, what does this opinion to the presidential reference say? Well, this opinion clarifies that as far as deadlines are concerned, timelines are concerned, that is simply not the court's power. It simply does not have the remit, the power, the jurisdiction, the scope to start telling the President and the Governor that, look, this is a timeline within which you have to decide on bills that are being sent to you by state assemblies. That's one. But having said that, there are a number of caveats that the Supreme Court has given with respect to powers of the Governor. All of this issue, of course, arose with a number of opposition-ruled states, the likes of Kerala, Tamil Nadu, Punjab, raising the issue before the Apex Court that bills are being passed by the state assemblies, the governors are sitting on them indefinitely. To that end, this opinion by the Apex Court has clarified that, number one, the Governor has 3 options. He can either agree, he can send the bill back to the state assembly or refer it to a president. What the Supreme Court today clarified is that the Governor cannot sit on it indefinitely, cannot defeat the entire legislative exercise, that it is the cabinet, the elected government that needs to be in the driver's seat, that this is something that the Governor cannot do. What the Supreme Court has also said, that as far as deciding of this granting of assent is concerned, to that end, while the Supreme Court says that no deadline can be prescribed, the Supreme Court also says in the same breath that there needs to be a decision by the Governor in a reasonable period of time, leaving the door open that tomorrow, if there is a situation that a bill is being passed but is awaiting the Governor's assent, the Governor is sitting on it indefinitely. There is a window now available for opposition-ruled governments to actually come and approach the Apex Court. So clearly, the Supreme Court trying to do a balancing act, on one hand saying that no timelines can be prescribed, but also in the same breath saying that governors cannot sit on these bills that are being passed by the state assemblies indefinitely. They need to take a decision, and they need to do so in a reasonable period of time.
All right, Ashmit, many thanks for those details. Now, India's Commerce Minister Piyush Goyal is in Tel Aviv on a 3-day visit to push for the long-pending free trade deal with Israel. He is leading a 60-member delegation to focus on deepening trade, investment flows and innovation partnerships. Abhimanyu Sharma reports from Tel Aviv.
India's Commerce and Industry Minister Piyush Goyal is on an official visit to Israel. He's expected to meet Israel's Minister for Science and Technology as well as Israel's Minister for Economy, Nir Barkat. In course of the next few days, there are B2B engagements expected between the Indian and the Israeli industry since a 60-member delegation from India from across several businesses is already present in Israel. There is also a likelihood that a potential FTA between India and Israel may also be discussed as part of the ongoing engagements. India is looking for more collaboration with Israel in several areas, particularly in areas of technology, innovation, wastewater treatment, and several possible joint ventures between both the sides. Now, several Indian companies are already invested in Israel and vice versa, and both the sides are looking to increase this engagement and possibly elevate this engagement by means of a free trade agreement between India and Israel.
I can assure you, friends, our first quarter growth was 7.8%. Our second quarter numbers are expected soon, will be about 7%. And I think at the end of the year, our year ends on 31st March 26, we will be growing at 7%, well above the world estimates.
Israel is a great startup nation, India is a great scale-up nation. So how do we, the real conversation was how do we combine the technological leverage that Israel has versus, and using that technology to do advanced manufacturing in India, to partner on AI and other advanced technologies, to look at sustainable things like sustainable areas of sustainability, like particularly in water, agriculture, and obviously energy transition.
And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surbhi Upadhyay. Now, asset allocation. You've often heard on this show itself, a lot of experts talk about how important it is to diversify our investments across different asset classes. So it's very important not to be squarely focused on any one, equities or gold or fixed income. This is where hybrid funds come in. And within the hybrid category, one category called the multi-asset allocation fund category, this has been garnering a lot of investor attention. In fact, the flows into this category have been going up, and we'll put up some of the data points that highlight that. At a time when mid-cap and small-cap funds, traditional equity funds, they've been getting lesser flows, and I'm talking about the latest numbers which came in from the industry body AMFI. At a time when regular equity funds have seen slight dwindling in flows, this category, the multi-asset allocation category, has been quite steady. As you can see out there, flows have been averaging anywhere between 5,000 to 6,000 crores on a monthly basis. So what's behind this trend? Is it sustainable? And is this fund category really an important one when it comes to us and our journey of wealth creation? That's what we're going to discuss with R. Sivakumar, Head of Products and Corporate Strategy at Axis Mutual Fund. Sivakumar, thank you so much for joining in. It's a pleasure to have you, especially personally, now that you've taken the trip and you've come to our studio. So thank you so much.
Thank you for having me.
So, Sivakumar, this is an interesting topic because in your earlier avatar with Axis Mutual Fund, I mean, you're a veteran of the fixed income market anyway. Now you're overseeing a lot of other categories as well. So just walk us through what you've made of the investor psyche and shifting investment trends as we've gone through a year of low returns to almost no returns in the equity category.
Yeah. It's a good place to start. I think equities have had a great run, and I think equity mutual funds have continued to see inflows despite, as you rightly said, well, not poor performance, but I think consolidating performance, I will say, for the past year or so. It's interesting that flows have continued to be at a steady clip, maybe slightly off from the peaks in terms of net inflows into that category. One of the interesting things that we've seen, especially over the last six years or so, post-COVID, is that investors have continued things like SIPs even when there is market volatility, which was not the case before. Every time the market would slip, you would see SIP cancellations and redemptions because people would, get frightful. This is the first cycle where we have seen kind of an equity culture, if I may say so, getting built, wherein people are staying invested and adding to their investments, even if the market returns, near-term market returns are not very strong. So I think that's the first and most important thing that you can see in terms of investor psyche, let's say over the last few years that we have observed.
Okay, so that's what's happened so far. And then, I mean, tying in with that, and we always talk about it when the mutual fund numbers come out and everybody's looking at the net equity number, and sometimes it's lower, and it's come down a lot from 40,000 crores per month to about 25,000 odd. But since I do this show and I look at personal finance, I see it as a sign of maturity, because simultaneously flows into hybrid funds and into this particular category, multi-asset category, they have started going up.
Yes.
So would you say that the lesson of asset allocation, that's finally getting learned? Is it getting learned well? And then, how do we look at some of these hybrid categories when it comes to asset allocation?
Yeah, it's a great question. And I think you're absolutely right. Multi-assets flows have remained strong through this entire cycle. So one could argue, why is it if equities are done so well, why is it that people are investing in multi-asset and so on? I think a couple of key factors drive it. One is the relative stability. So when you look at long-term returns from multi-asset as a category versus equities as a category, returns are in the same ballpark, very close to each other. There are some really long periods of time when multi-asset has outperformed equity even, but at a much lower level of risk. And so the first thing is multi-asset as a category, I think, has proven itself. And this is not an India story. This is a global story. Across many markets, you have seen this data that multi-asset as a category has delivered similar return to equity, but at a much lower risk. The second thing that has happened, I think, is the tax change on fixed income funds, which happened a few years ago, and therefore the drop-off of fixed income allocation.
Yeah.
And people have chosen to invest in multi-asset and other hybrid categories as a proxy for debt, meaning to also get some debt exposure. I mean, that's one of the important drivers of flows into hybrid as a category as compared to traditional fixed income as a category. So I think that's something which again multi-asset as a category has managed to capture. That is to say, you get an exposure to fixed income and gold and equity at the same time, and you get a much more tax-advantaged way of playing those three assets together.
That's a very important graphic on our screen right now, and let's just explain that to our viewers. What you're seeing is basically how asset classes perform across different market cycles. And there is never a fixed rule. You can never wake up on the 1st of January and say, this is the asset class that's going to be the winner of the year. Because in this data, we've taken 3 different buckets, 5-year buckets. And you can see in the first bucket, immediately after the global financial crisis, which is 2008 to 2013, equities weren't doing that well. The Nifty 500 is actually down. The 10-year G-Sec yield, basically fixed income was a better performing asset class, 9%, and gold, because we were in a risk-off environment, gold did really well. Come to the next 5-year bucket, 14 to 19, again, the returns are varying. Equity and gold somewhere around the 7 to 8% handle, fixed income 9%. And then the real equity bull market actually took off just after COVID, which is about 17-18% equity return, fixed income 6.5%, but gold did well even in this period. Now, who's to say, at least I cannot extrapolate the next 5 years and fill the 4th column of that table. But that's the thing. So, Shivakumar, let's address this. Asset allocation. For a lot of investors, they equate asset allocation to chasing kaun sa asset class acha karega. Now, gold did well, so let's put some in gold. And, maybe equities did really well, so let's go full hog on equities. How do we break out of that psyche?
It's important that you break up asset allocation into 2 parts. What's called strategic asset allocation and tactical asset allocation. Now, strategic asset allocation has got everything to do with your return risk profile, and when you look at studies which say asset allocation explains all the returns of a portfolio, etc., those studies are based on strategic asset allocation, meaning how much you allocate to the different assets you own substantially explains the returns rather than individual stocks or bonds. It's really how much you allocate which matters a lot when it comes to long-term performance. That's the first part, right? Once you've agreed on a strategic asset allocation, let's say the classic portfolio 60-40, 60% equity, 40% fixed income. And these days, that's up for debate. Does that 60 become 61 or 65, or does it become 55? So how do you at the margin make that allocation decision on a year-on-year basis, or even on a 5-year cycle, as your data just showed, that for 5 years you can have different assets perform differently, right? That's where tactical asset allocation comes into play. So tactical asset allocation is about trying to play shorter term cycles, from a few months to a few years, where you take a call on which asset class should be overweighting or underweighting. And I think that's where these multi-asset funds which take asset allocation calls come into play. See, as an asset manager, I cannot create every strategic asset allocation there is. Some investor may be close to 0% equity and some are 100% equity. Can I create products at every mix? Not possible. But we can create products which take these tactical calls.
That's a very important and very interesting thing you said. So first of all, it's okay to take tactical market-related calls with respect to asset allocation. It's not like against the cardinal rules of financial planning. There is the overall asset allocation that you should have depending on the nature of investor that you are. I mean, are you a risk-averse investor or etc. But there is a tactical element to it. And that's where these multi-asset funds fit in.
Correct. And you can do this by having multi-asset funds which buy directly into stocks and bonds and gold, etc. But you can also do through a fund of funds route wherein you're investing across, let's say, equity mutual funds, debt mutual funds, gold ETFs, and so on and so forth. So I think the way to play this is multiple ways. If you're, for example, owning a multi-asset fund in the traditional way, which owns stocks and bonds directly, then it's more of a bottom-up picking of stocks, and with, of course, macro and other overlaid. But you can also do a fund of funds approach where you're doing a lot of top-down, right? Trying to figure out top-down, what's the right allocation to have, and then trying to find which funds, which strategies. Do you want to go into thematic or sector funds? Do you want to buy flagship equity funds? Do you want to similarly do on the credit side or a duration side, etc.? So that becomes an interesting way to have 2 or more approaches to tactical asset allocation.
Okay, so that's lesson number 1 that we've learned, that multi-asset funds could be an interesting way of blending more asset classes in a smart way into your portfolio, because we may not know all markets. We do not know which asset class could perform which way. There are, fund managers who have better visibility in all this and are more equipped at taking those calls. Now, Shivakumar, again, lesson number 2 is just understanding what these multi-asset funds look like, what is their structure. So I believe they have to invest in a minimum of 3 asset classes, right?
Correct.
And is there a minimum threshold, holdings? What is their overall, and what is the regulatory framework?
The regulatory framework is, yes, minimum 3, and the minimum within. So for example, if you have equities, that has to be minimum 10%. If you have commodities, that has to be minimum 10%. So from a regulatory perspective, to qualify as a multi-asset fund, you need to have minimum 3 asset classes, and each of them have to be meaningful. You cannot have
10%
1 or 2% in an asset class and call that a multi-asset fund. Right? So the idea is to have some meaningful allocation, and the regulatory minimum is 10%. So most of the funds in the industry have gone with equity, fixed income, and gold, or commodities in general, gold, silver, and other commodities, as a way to satisfy this need. And I think that's probably the right approach. You could add global stocks, for example, as another asset class in this. I don't think anyone's really doing it. And in the current situation, of course,
There are limits on the global
limits,
exposure that you can take.
and that creates its own challenges. So therefore, today that may or may not be the right way to do it, but at least you can have minimum of 3, minimum of 10% in each. Whether you do that through direct investments or through a mutual fund, it's fine. But the idea is to have at least 10%. That's something meaningful. The second consideration that comes into play here is, of course, taxation. As we discussed, on debt, taxation is quite punitive in the sense you get marginal tax. Whereas if you do a fund of funds, or if you do a 65% plus equity or a 35% plus non-fixed income, then you get long-term capital gains tax, which is way more beneficial to investors. So that's the other consideration that fund managers have. That in theory, you could have a multi-asset fund which is 80% debt and 10% equity and gold, but it doesn't make sense because it's far more tax inefficient. So you would want to be equity heavy, or you would want to be at least reasonably balanced.
But that's also an interesting dilemma, perhaps, that it raises in itself, taxation. Yes. Because like you explained, that if first of all, there is no standard taxation rule for multi-asset funds. Please be very clear and make sure you keep asking your advisors about this, because the way a multi-asset fund will get taxed will depend on the amount of equity it's holding. If it is holding more than 65% of its assets in equity, only then does it get the advantage of equity taxation, which means that after 1 year, you pay long-term capital gains tax at 12.5%. So that's the most favorable taxation from our perspective, from the investor perspective. But that also raises a question, and just tell us what you see across industry. In order to be tax effective, if most multi-asset funds are anyway loading up on 65% equity, then are they really being true to their mandate, which is offering a great balanced multi-asset portfolio?
Yeah, so there are two choices. One is about 65% equity to qualify for the 1 year long-term capital gains tax. The other is to be above 35% in non-debt. So up to 65% in debt, but not crossing that 65 threshold, which means you get long-term capital gains after 2 years, but the same rate. So which essentially, 2 years is nothing for a asset allocation investor, right? So I think for investors who have beyond 2 years, you do have a greater choice of these multi-asset type of products, because you can do pure equity or equity biased, or you can have a more balanced portfolio. So both options are on the table. I think we take too short a view sometimes, and we believe that 1 year is important, but 1 year is not important from your investment life cycle, right? You are investing maybe for 5 years, 10 years or more, and so it makes sense to look at these funds from a longer term perspective rather than from a 1 year perspective.
Okay, all right. So now we've learned the basics of this category, the multi-asset allocation category. We'll come back, talk about reasonable return expectations from this category, and also figure out what are the kind of funds. How do you choose the right fund? How do you blend it with the rest of your portfolio? That and more after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are discussing multi-asset allocation funds, why they are important, and just how they can complement your portfolio for better, more balanced, and more sustainable returns. And of course, we have with us our Sivakumar of Axis Mutual Fund for this conversation. So Sivakumar, the most interesting part, returns, right? So experts like yourselves tell us that from equity, I mean, reasonable expectations would be like 12 to 14% compounding returns over long periods of time. In good years, it could touch 15%. Now, if you add more masala to the mix, because you have multi-assets now in this fund category, then what's the return expectation?
I would hope that this category can deliver returns which are broadly similar to equities, but a lower risk rate. So what that means is that, why that happens is because of the two things. One, these funds tend to be less volatile, therefore they have less drawdowns. I mean, if you think mathematically, right, if a fund falls from 100 to 90, there's a 10% fall. To get back to 100, you need 11% gain because 90 plus 10% is only 99. So it's not enough to get back to where it was. So the drawdowns are never fun. I mean, if you go from 100 to 75, which is a 25% fall, you need a 33% return to go back to previous peak, right? So volatility containment is the first way that these funds manage to keep return. The second thing is being able to take calls. I mean, as you pointed out earlier, this cycle gold has, I mean, equities have done really well, but gold has done even better. So how do you kind of have a process around picking which asset class to buy and therefore be able to deliver some alpha through that? And because of this, we expect returns in this to compete with equities. I think in a bull market, it's tough to beat an equity fund, but over a cycle, to be able to compete with equities in terms of performance at a lower rate of risk is what we would expect to do. And as I mentioned before, right, one of the interesting things is this is across the world. It's not an India-specific story. If you look at asset allocation, everywhere in the world, you've seen similar to equity returns at a lower rate of risk. So it's globally valid statement that returns for multi-asset will be similar to equities.
Okay, that's quite phenomenal, right? Equity-like returns with lesser volatility. Now, who wouldn't want that? Which also brings me to the question, then how do you pick the right MAF, as they're called? If you hear that acronym MAF, you know we're talking about multi-asset allocation funds. How do you pick the one that's right for you? Because all of them would be running different strategies. Someone would have, more gold, less gold, more equity, less equity. So how do you decide?
I think, first of all, align to the asset allocation choice. I mean, as we discussed, some may have more than 65% equity and therefore bias will be towards higher volatility or higher equity allocation, and others would have a more balanced mix. So take that. Go for the right strategy. I mean, are you doing a pure equity debt approach, or are you doing fund of funds? Because again, that makes a difference to the return profile and the risk profile of that. So I think choices should be made more on the underlying asset allocation or the ranges which the fund managers are guiding, and the investment strategy. Is it a top-down fund of funds approach? Is it a bottom-up stock picking approach? And that would be the primary driving force. And of course, track record does matter. So you'll have to look at whether in the fund house is delivering on that, whether it is through returns or whether it is through actual positioning. I mean, if you are claiming to be an active asset allocator but you run passive, that's not helpful. Similarly, if you expect to be passive but then you're seeing wide ranges, again, that's not helpful. So what does it align with your view? As an investor, does the fund strategy align with my view? And that's going to be the first port of call.
Okay, fair enough. So plenty to think about as you make your final choices. Now tell us, at Axis Mutual Fund, what's the house call on different asset classes? I mean, what are you guys tactically most bullish on as we get into 2026?
The interesting thing is there's been a change in the market outlook over the last year or so. I mean, the most important thing, and I come from a fixed income background, so I'll start there, which is to say that, we've had an RBI which is extraordinarily accommodative, and yet bond yields have risen for the best part of the last several months, which usually is a signal that the economic cycle is turning up. Right? So expectations of inflation are slowly going up, and eventually with a 1 year, 2 year forward view, the market slowly expecting rates also to start moving up. That's what this suggests to me, that why is the market not reacting to today's movement of the RBI? Now, if the economic cycle is turning up, then obviously that's going to mean equities are
positive for equities.
Positive for equities. So really speaking, even though we've had relatively soft equity performance and relatively good bond performance over the last couple of years, I think the script is likely to flip, and bonds are likely to be middling. And I think if the growth cycle comes back, then equities will outperform. The other thing is how India has performed relative to the world. We have underperformed, and underperformed massively. So the valuation, or shall we say, the valuation premium of India to Asia or to the world has massively corrected.
Reduced, yeah.
Right? And we are now reasonably valued compared to the rest of the world. And if there is a change in the global investor psyche to move away from tech and AI, etc., to going back to fundamentals, then I think India will be a big beneficiary. As an allocation, so much of the money which has gone out of India has gone into tech stocks or China or any of these themes. And if that theme changes, suddenly you will see a big beneficiary. So I think we are a lot more positive on equities. I think fixed income will be more middling. I think gold really is about playing shorter term cycles, figure out gold and silver. Relative performance between gold and silver has been an important theme for us, rather than just absolute call on where gold will go. I think we'll continue to play that.
So still bullish on both gold and silver?
No, like I said, it's not about bullish on gold versus bullish on silver. I think for us, the way we've made money is actually weights between the two, meaning at what point of time do you want to be overweight silver, overweight gold. Keep a reasonable allocation, but play through relative valuations, relative prices, let me say.
All right, so that gives us sort of a broad framework that you at Axis Mutual Fund, your teams are deploying to take those investment calls. Finally, back to multi-asset allocation funds. In an overall portfolio that'll have equity, large cap, mid cap, small cap, it'll have some other maybe these dynamic asset allocation funds as well, because they also move across equity and debt. How much should we give to MAFs?
There is no, this now, we moved it from a realm of asset management into personal finance. And I think it's a great place, it's a great question from that perspective, because it affects all of us individually, right? At a minimum, it should be 10-20% of your portfolio should be in this mid space, meaning it's not pure equity, pure any one asset class. Then you need to have the tactical ability to switch. But then it changes according to every investor. So there is no one way of looking at it. But have a reasonable allocation, because these small cycles, 1 to 3 year cycles, do make a difference when it comes to performance. And as a normal investor, I mean, I work in an asset management company, and yet I myself take a reasonably passive view to my own investments, right? Because I'm not out there trying to make changes on a daily basis. So why not let an asset management company, let a fund manager pick that call, and you make your broader decisions as an investor. And that's why I feel that have a small but meaningful allocation to this hybrid category.
Okay, all right, Shivakumar, thank you very much. Great insights there, and plenty of food for thought, as well as perhaps investors look at getting more involved with their portfolio, adding more hybrids, and adding more than equity in terms of asset classes to their portfolio as well. Thank you so much for this conversation. Well, thank you, viewers, for being with us. Keep sending us your feedback, comments, queries, and of course, we'll see you again next week with another theme.
Let's talk money.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. The Supreme Court has refused to prescribe timelines for governors and the President of India to clear bills passed by state legislatures. The 5-judge bench today said that there is no concept of deemed assent. However, the top court signaled that limited judicial scrutiny may apply in cases of prolonged, unexplained and indefinite delay in granting of assent. The bench further clarified that the governor cannot withhold assent if a bill is passed for a second time without any amendments. The court also remarked that governors cannot act as super chief ministers, stressing that there cannot be two executives within the state. This comes after a rare presidential reference was made to the court over its verdict in April, which had imposed a 3-month deadline on dealing with bills that have been passed by state assemblies. To discuss this further, we have with us senior advocates, Mr. Dushyant Dave, Ms. Geeta Luthra, as well as DMK spokesperson Salem Dharani Rajan. We'll connect with all of them in just a bit. But first, we have Mr. Dushyant Dave with us. Mr. Dave, pleasure speaking to you once again. Thank you so much for joining us on CNBC-TV18. First, for the benefit of our viewers, if you could tell us the difference between a judgment and an opinion that has been given in a presidential reference like we saw today and the impact that it has. Are we now looking at a situation where the 3-month deadline that the Supreme Court gave in April stands overturned? Mr. Dave, I believe you've muted yourself.
Sorry. The difference between judgment and opinion is simple. Judgment is binding, the opinion is not. Opinion is given on a request by the president. He makes a reference to the Supreme Court and seeks the views of the Supreme Court. But be that as it may, the judgment definitely will have an impact on what was held earlier by Justice Pardiwala and Justice Mahadevan, in which they said that the governors are subject to the mandibus and that there is a time limit, and they prescribed a time limit of 3 months. To my mind, today's opinion is undemocratic, and it really runs completely contrary to the fundamental principle of parliamentary democracy, which applies both at the center and the states. The governors, or the president for that matter, are under the Constitution. They are not above the Constitution. Under our scheme, constitutional scheme, nobody is in imperio. Everybody is under the law. And another aspect is very important, that every power which is vested on any authority, be it constitutional authority, judicial authority, or anybody else, the power must be exercised reasonably and within a reasonable time. And here, shockingly, Articles 153, 154, 163 and 200, if you read them together, there is no doubt in my mind that ultimately the democracy rests with the cabinet and the legislature. Once the legislature passes the bill and that bill is sent to the governor for assent, the governor has an obligation to approve, unless the governor in his discretion in certain cases may send it back to the legislature for reconsideration or may refer it to the president. And again, but that has to be done as soon as possible. The words which are used in Article 200 are as soon as possible. Now you can't therefore say there is no time limit. I think this judgment opinion of the Supreme Court, to my mind, is unconstitutional. It runs against what has been held by the Supreme Court for last 77 years, that everybody there is nothing called an unreviewable decision under our constitutional scheme. And it's therefore very surprising that judges have taken this view. I think I am deeply disappointed at today's opinion, because this really, lets loose a situation where parliamentary democracy, especially in states, will become, subject to, the discretion of the governor.
Sure.
And governor, therefore, will, in effect, hijack the democracy from the people through the legislature into himself, which is not really what was intended by the constitutional framers. After all, president and governor both are formal heads of the state, nothing more.
Fair enough. Let's also get Ms. Luthra in on this conversation. Ms. Luthra, again, Mr. Dave giving us a view that you cannot have two persons on the driving wheel. That appears to be a view that the Supreme Court also gave. Only it's unhappy with a 3-month deadline. Firstly, to begin with, give us a sense what happens to the April judgment which gave a 3-month deadline to the president and the governor. Do they still have a deadline? Is there a review of that judgment that is now required? How do we go about it? What is the law of the land? Is there a 3-month deadline?
See, the very fact that 3 judges have answered this fact that the reference has been answered, I feel that it really waters down that judgment which was given, which to my mind was the landmark judgment and which is the way to go. Because ultimately, it cannot be withheld without any reason and has to be decided as soon as possible. What is the role of the governor? We have a parliamentary system of democracy. In a parliamentary system of democracy, the governor's role is really very limited. He cannot be seen to be withholding bills. He cannot do this indefinitely. And to that extent, the judgment of the bench led by Justice Padiwala, which put a timeline, and it's not unknown that the courts have in interpreting constitutional provisions and statutory provisions read into a reasonable timeline. So my thought would be that that was welcome. And to that extent, this waters it down. Obviously, an opinion given by a larger bench in a presidential reference will have very weighty value to it. Now,
sure.
It does water down that judgment. And for that, I can only say the court saying that it should not be unduly delayed. And as and when there is something which is completely unprecedented, you can approach the court. To my mind, it's a step backwards.
Right, Ms. Luthra. Mr. Dave, let me come back to you. At a time when Ms. Luthra as well is saying that, look, we've watered down the April judgment, which had given a 3-month deadline. What I want to ask you is that at a very conceptual level, the Supreme Court appears to be today saying that, look, we can't say that the president or the governor need to decide within 3 months' time, but at the same time, they should decide within a reasonable period of time. What the Supreme Court effectively appears to be saying that, look, I don't want to be very specific in telling you what you need to do, how you need to do it, but a broad range I can give you that within a reasonable time, if not 3 months, then maybe 3 to 6 months, it should be done. Are we muddying the waters? Is that a concern?
Let me tell you one more thing. You know, the actions of the president and the governor are not like judges who sit over their judgment sometimes for months and years. I mean, and nobody can question these judges, why they are delaying their judgments. But here we are talking about in a state, a party with a majority has formed a government. It has its aims and objectives as they have been disclosed in the manifesto. It wants to achieve them because the electorate have elected them on the basis of those aims and objectives. It therefore brings certain bills. Now, bills are passed. If the governor is going to sit over them for even more than a week, according to me, why 3 months? Why 3 months? The governor must approve them as soon as possible. Maybe 24 hours, maybe a few days, maybe a week. But the whole purpose is that ultimately the people's voice has to be heard. And governor cannot stifle that voice by, sitting over these bills indefinitely, certainly not even for 3 months. Because, in a 5-year period that every legislature has, every day counts. The party in power wants to do something because it has been elected on certain promises. Now,
Right, Mr. Dave.
What we have seen, Asmit, is something very startling. What has been happening since 2014 is that in BJP-run states...
Dave, I'll just interject there. You spoke of...
One more thing, Asmit.
You spoke of the party... Yes, Mr. Dave, please go ahead.
This is happening more in opposition-run states. And that is a matter of sad commentary because the judges are blind to the fact that in BJP-run states, the governors approve the bills within a week or two. So why is it that you are allowing this situation to continue in opposition-run states? You can't, a governor, firstly, we are seeing that every governor is in an opposition-ruled state is acting.
So I'll just come in there, Mr. Dave. You spoke of the opposition-ruled states. And in fact, that's how this entire issue began, where the states of Kerala, Tamil Nadu, Punjab had to knock on the doors of the Supreme Court. And speaking of parties in power, we have with us Mr. Selam Dharan, the spokesperson of the DMK. Mr. Selam, just again quickly, what is the takeaway for you here? You were celebrating when the Supreme Court had said that, look, there's a 3-month deadline, the governor needs to approve the bill within. Now, what are the legal consequences that you're looking at? What is the legal advice that you're getting? Are you looking at a situation where, again, the bills could be passed and you would not have enough clarity on when the governor would grant the assent?
The gubernatorial procrastination has been happening in all non-BJP rule state, and that is the problem. In a democracy, for example, in Tamil Nadu, 8.4 crore people of Tamil Nadu vote and select their member of legislative assembly. These MLAs in turn select the chief minister, and chief minister selects the state council of ministers. The state council of ministers and the legislator legislate. So where do we get the legitimacy from? We get the legitimacy from the people who voted us in power. So whatever we express, it is nothing but voice of the people of Tamil Nadu. So bill that is passed in the legislature is nothing but that which represents the voice of the people. So if a governor is sitting on it for more than 6 months, 1 year, or sometimes on need 2 years, if you do a survey in Tamil Nadu, 95% of the people would say we don't want need, which is why we have passed a bill. But the governor has been sitting on it for 2 years or 2.5 years. So if a governor sits on a bill for more than 2 years or 2.5 years, which is more than 50% of the overall term limit, then it's a travesty to democracy. And that is a big problem. And already, if you read the Constitutional Assembly debates as well as the Constitution, it clearly says the governor should clear the bill within as soon as possible. So why have the governors been sitting on the bill inordinately? Because what is as soon as possible? For me, as soon as possible could be 5 minutes. For someone, as soon as possible could be 2 years. Right? Which is why, because
that's a very pertinent point. Right.
Because the constitutional framers did not set a time limit because they never expected people of low constitutional morality to hold the position of governors or presidents. That is a more interesting point. Only in the last 10 years, we have been seeing such governors.
Right, Mr. Selam. Right, Mr. Selam, I'll just have to come in there. That's a very pertinent point that you raise. What is a reasonable time? The Supreme Court's view is we can't give you a specific timeline, but we want it to be done within a reasonable time.
No, 10 seconds.
Yes,
10
Mr.
seconds. I
Selam.
just need to add on.
Yes, Mr.
So
Selam.
when they said 3 months, it was an extraordinarily good judgment. But now again by saying you can't inordinately sit on a bill, what do you mean by how long is inordinate? 5 years, 10 years, 15
Which is
years,
the very question.
20 years?
Let's take that question across. Let's take that question across to the legal experts that we have. Ms. Luthra, coming to you. This quandary that the Apex Court has now, the Supreme Court has now left us with, that the governor needs to act within a reasonable time. What is a reasonable time? There are cases where bills were pending for over 2 years. Is that unreasonable? Is a 3-month wait unreasonable? How do we now look at the Supreme Court deciding on a case-to-case basis that, look, in this case, this is a reasonable time, 2 months is a reasonable time, 6 months is a reasonable time? How do we go about answering this question? What is reasonable? Ms. Luthra.
See, this was the most brilliant opportunity for the court to show its mind as to what is a reasonable time. To my mind, a week or 2 weeks, unless the bill is very complicated, is a reasonable time. Ultimately, a governor is really a titular authority. The governor's role is only to act on the advice of the Council of Ministers. So he has this authority and the power under Article 200. But as soon as possible, even say in suits of specific performance, are saying 2 months. I think even that is too long. There may be a bill which was crying, which may be part of the manifesto of a party. And it's crying for being decided one way or the other. So the governor cannot but act with great expedition. And I would have thought that in the reference, this opportunity of setting things right or laying guidelines, because why do we have 3 wings of governance.
So an
Why do
opportunity lost, Ms. Luthra, is how you're
Yes.
describing this opinion that the Supreme Court has given. We're running out of time. Mr. Dave, I'll come to you for the quick closing comment. Do you see a silver lining? What happens to parties like the DMK who are ruling in the Tamil Nadu? What happens to them? We've seen previously that they had to knock on the doors of the Supreme Court. Has that door been kept open by the Supreme Court giving an opinion that the governor needs to act without inordinate delays, and that is the open door for opposition-ruled governments to actually come to the apex court and say that, look, we need relief, we need our bills to be passed? Is that a legal remedy, a legal relief that is now available to opposition-ruled states?
I think the judgment sounds death knell on parliamentary democracy. And it's really a sad commentary on Supreme Court that it has lost opportunity, as Ms. Luthra rightly points out. If you look at Article 154 or 163, both say that governor shall act as per the Constitution and shall act as per the advice of the Council of Ministers. These are words mandatorily used. So, principle of constitutionalism requires governor to act as quickly as possible. And if the governor does not, then Supreme Court is wrong in saying reasonable period, because reasonable period is a completely vague term. So to my mind, Supreme Court's judgment is most unfortunate, although I must confess that I did expect this opinion from the 5 judges.
Strong language there, Mr. Dave, but I'd like to thank all of our panelists for joining us and sharing their perspective. Ms. Luthra, Mr. Dave, Mr. Salem, thank you so much for sharing insights on what was, again, a landmark opinion that the Supreme Court has given with respect to the powers of the governors, the conduct of the governor, as well as the president. The Supreme Court doing a balancing act, trying to say that on one hand, you can't have a 3-month deadline being given to them, but in the same breath saying that they need to act within a reasonable period of time. That's unfortunately all the time that we have. We're heading into a very short break. We'll continue and bring you more. And this is on AI. AI has been all the buzz. But what about safety? I spoke with Evan Kotsovinos, VP of Security at Google, who says that deepfakes are the biggest challenge. That interview is coming up shortly. Welcome back. Now, AI has been a buzzword for the last few years, but today we look at AI from a safety lens. I spoke to Evan Kotsovinos, the Vice President of Privacy, Safety and Security at Google, and he believes that one of the biggest challenges with AI is deepfakes. I asked Evan earlier today and started by asking him about safety concerns around AI and how watermarking can help tackle deepfakes. Listen in.
We're excited about the enormous economic opportunity that comes with AI, both in India and globally. And we see safety as absolutely foundational to that opportunity being realized. Like any big technology change, AI is used for good and for bad. And so we're seeing several areas where there is increased risk and increased threats with the use of AI. The most obvious one is probably deepfakes. If you think about things like the digital arrest scam here in India, which is very common. That's clearly empowered by AI. We're seeing hyper-personalized spear phishing. We're seeing AI being used for cyber attacks increasingly. So there are multiple dimensions where we're doing some really committed, dedicated work to address these and to stay ahead of the bad actors.
Let's talk about deepfakes. That's, of course, one of the areas as well that you're trying to address. I just want to bring in, of course, what the government's thinking is. The government is very concerned about deepfakes, the impact that this synthetic content, AI-generated content has on public conversations, public sentiments, how it influences elections. You mentioned digital arrests. That's something that the government is very, very concerned about. They've proposed changes to the rules as well to ensure that there is watermarking of AI-generated content. How far along are we in that journey?
Watermarking technologies are evolving quickly. We are investing in adopting those technologies in our products. Anything you generate with Gemini will be watermarked. And we'd like to see the rest of the ecosystem do the same. So in spirit, we're in support of the direction the government is going. But I think watermarking and provenance technologies are going to be part of the answer, not the full answer. To your point, the reality is that it will take many years for watermarking to be adopted across all of the models, if it ever happens. And so we need technologies that detect media that is AI generated. Sure. And then we need to incorporate all these things into the delivery surfaces that the users are using. So for example, the phone, right? If you're on the phone and you're in a digital arrest kind of situation, and there's a way to detect that, we need to alert the user on the phone that this is happening. So all these things need to come together for the problem to actually be addressed. And it's not something we can do alone. It's something that we need the whole ecosystem to stand behind.
When you talk of bringing the entire ecosystem together, is there a case to be made that whether it's at the phone level, at the manufacturer level, or at the level of, say, perhaps a Google or a YouTube or a platform that is provided, for there to be perhaps some inbuilt tools which can help alert users to such AI-generated synthetic content? At least can that be a start?
Platforms have to take accountability for the safety of their users. So there's a fine line between the platform being responsible for the content that's being uploaded to the platform and the platform being responsible for the safety of the users. Right? There's a fine line between those two, but they're also distinct. In my mind, platforms have responsibility for the safety of their users. We certainly approach it that way. And it's important that everybody else does as well. And we coalesce on watermarking and provenance. We coalesce on keeping users safe.
Is there a need for perhaps a dedicated mechanism or a dedicated AI audit or safety office here in India as well that will give more clarity, more direction in terms of what are the steps that perhaps need to be taken?
You know, I'm not super clear on the organizational structure of the different bodies that provide governance and sort of control and regulation in this space in India, so I can't comment on the structural question directly. But I think certainly to the extent that clarity can be provided and that clarity can be durable, that is very helpful. One of the challenges with regulating AI right now is it's changing so fast. Regulatory timelines are long by necessity, by nature. They go through public consultation processes and so on. And so trying to regulate such a fast-moving space is not straightforward. So I have respect and admiration for the regulators who are trying to do that.
There are a recent set of regulations that have been introduced here in India which talk about ensuring parental consent, where platforms like Google will be required to, while processing data of children, will require parental consent or parental authority. Is that a workable mechanism? Do you feel that that's something that can be implemented not just in letter, but also in spirit?
So I would say a couple of things there. First of all, I'll get to consent, but before I get to consent, it's important that age is assured across different platforms. What I mean by that is that different providers of content don't just take the user's word on their age, but they actually take some steps to assure that the age of the user is what the user says their age is. Because without that information, you can do all the consent that you want. If a child claims they're an adult, all bets are off. So it's very important that the ecosystem, again, invests and focuses on age assurance. We're doing that in a very committed way. We're rolling out age assurance technology globally to make sure that we understand whether our users are adults, minors, or children. Consent-based solutions generally are common and workable. Of course, the specifics depend on how the requirements are exactly defined and worded, and how the age limits are sort of tuned and so on. So, we'll have to look at the specific proposals to comment more concretely. But in principle, we have no problem with consent-based approaches. We use consent heavily in a number of different contexts, and it's a constructive direction of exploring towards the right solution.
When we're talking of user harm, a lot of the conversation slowly crawls back and travels back to some of the algorithms that are used. Is there a case to be made for perhaps some form of audit of these algorithms to check for user harm?
We will do what we have to do to comply with whatever the regulators require us to. We operate within the boundaries of the law in India. India is a sovereign country that will decide what is right for India, and will comply with whatever we have to do. So I would say our concern is not whether this whether the inspection of the algorithms will touch on intellectual property or not. We will comply no matter what. We'll do what we have to do. I think the question is whether it's effective. And given the complexity and the scale of these algorithms and the way this content is delivered to users, I think it will be an enormous challenge for that to be regulated effectively. In terms of at the level of the algorithm, right? I think it's more likely to be effective if it's regulated at the level of the outcomes, and seeing the safety outcomes that we expect to see for users.
Fair enough. While we're on the subject of safety, that's again an area where a direction that appears to be not just here in India but broadly across various geographies, there is an inward-looking approach that as long as it's personal data, we want that data to reside in the local country, domestically. That's a concern. Is that changing conversations for you from a safety standpoint, from a strategy standpoint? Because there was a time when we used to talk about if data is not allowed to move smoothly, then that'll come in the way of innovation. That'll be that'll be an anathema to cloud computing. But now we increasingly see more countries saying that, look, we want data to be localized here. We want that to be stored here, especially when it comes to sensitive personal information.
Yes. No, I don't think it necessarily stops innovation. We've made big investments in this space to try and deliver sovereign solutions that move in that direction. For example, in our cloud, we have our sovereign cloud solution in France and Germany, and we're piloting in other countries, which is a fully third-party operated solution. It uses Google technology, but it's completely detached from Google operationally. And we're working on federated learning technologies, which allow, in a privacy-preserving way, allow training models while keeping user data not just in the country, but on the device of the user. So I don't think it's necessarily a showstopper. It introduces new technical requirements, new complexity, but we're investing heavily in making sure that we marry innovation with sovereignty and with privacy in the appropriate way.
Well, with that, it's a wrap on this edition of News Center. More news and updates will continue right here on CNBC-TV18.
and welcome to the Medicine Box. Today, we're diving into a subject that often feels more like science fiction than medicine: longevity. The quest to live not just longer, but healthier. Recent headlines have pushed this conversation into the mainstream. Indian entrepreneur Dipender Goyal has invested $25 million of his personal wealth into a new scientific initiative, Continue Research, whose first hypothesis suggests that gravity itself may accelerate aging, hence an increase in average brain blood flow could help. Globally as well, longevity has become a frontier of bold ideas and even bolder spending. Biohacker Brian Johnson pours over $2 million a year into reversing biological age. Investor Peter Thiel calls death a technical problem waiting to be solved. The X Prize Health Span competition has put up $101 million for innovations that can improve healthy aging, and in March 2025, even the Vatican convened a summit on the future of longevity, underscoring how universal and urgent this topic has become. Meanwhile, research continues to advance rapidly, with new work emerging on drug repurposing and multi-drug interventions that could slow age-related decline. All of this, the capital, the curiosity, and the controversy, raises fundamental questions. Can we safely manipulate our bodies, our biology? Who will actually benefit? And what ethical boundaries must we respect as we push the limits of human lifespan? To help us unpack these ideas, we have with us Dr. Hemant Thakkar and Dr. Sahil Kohli joining in for this discussion. Well, Dr. Thakkar, I'm going to start with you, and let's begin with the headline that everybody is discussing about the fact that this gravity hypothesis by Dipender Goyal's research company, that anti-gravity can actually help in terms of reducing your age or reducing aging and helping in longevity.
I like the term hypothesis because it is a good hypothesis, but still a hypothesis. There is some truth that vascular health and brain health go hand in hand, and that if you stand up, the cerebral circulation drops by 10 to 20%, or if you have diseases like high blood pressure or diabetes, you compromise cerebral circulation, which can cause cognitive decline. But where it remains a hypothesis is that there are no biomarkers to this effect. And the inversion phenomena, even done by NASA, does not show anything to prove that the cerebral blood flow is the lifeline of longevity. So one has to look at it carefully. I agree this is a good hypothesis he has come up with, and one needs more facts.
Okay. Well, Dr. Kohli, this entire conversation about anti-gravity ties into the fact about the discussion about longevity, which is actually picking up so much pace. So when we talk about longevity, Dr. Kohli, what exactly does it mean to doctors such as you?
Longevity means adding life to your years. It doesn't mean adding years to your life. So the good quality of life where you are doing everything on your own, not dependent on others, able to travel yourself, able to cycle yourself, and do most of the things yourself, that is actually good longevity.
Okay. But Dr. Thakkar, when we talk about that, what does longevity mean to you? Because now we have a whole host of people who are almost celebrities becoming longevity advocates, experts. So what, according to you, is longevity?
See, science tells you that living long is not enough alone. You must live well. It's not the quantity of life alone, but the quality of life. If you have life backed with good, vibrant, holistic and science-backed lifestyle maneuvers, which do not give you cognitive decline or chronic illnesses, that's it. If you have a decade longer, but in that decade you're struck with cognitive decline, chronic illnesses, and you have to fight that last decade of life, it is of no use. So a decade long versus a little less but quality, that is, you have to change and chase health span, not lifespan. Health span over lifespan.
Okay. Well, just talking about that, there is data which shows that lifestyle changes itself can add around 12 to 14 years, disease-free years to a person's life. So what are possibly the 3 most evidence-backed changes when it comes to lifestyle in order to possibly extend your health span?
Excellent. Your data is correct. What goes in from the lips, what you eat and drink is most important. That's one. How much you can walk away from aging, which means exercise. Exercise in any form, isotonic, isometric. And 3, the mind over the body. If you sleep well, you have a relaxed mind. If you interact, you have positivity. If you're happy, you have a healthy and heartful, long, lengthy, happy life. So you must look for those 3 things. And if you adopt these 3 lifestyle changes, that's the best way. Of course, there is a genetic component which is there. But you can override this genetic component and live quality life, may not be longer, by practicing these 3 golden rules of lifestyle changes.
Okay. Well, Dr. Kohli, I'm just going to toss that over to you as well, because in your practice, in your practice itself, you must be probably seeing a lot of patients with early onset dementia, early onset Alzheimer's. So in that sense, how much of it is possibly lifestyle related? How much of it is genetic? And what do you tell your patients who are aging in terms of the best habits that they should probably adopt?
What we have to understand is that aging is a normal process. So once a patient of dementia comes to us, we usually try to see, is there a reversible cause of dementia which is sitting there? So there are some vitamins like vitamin B12 deficiencies, vitamin D deficiency. Some people who have other deficiencies can have, dementia. But more oftenly, the people who have comorbidities like hypertension, high blood pressure, high cholesterol, and who are obese, they are more likely to get it. On the other hand, if we are physically active, as Dr. Thakur has clearly told, we are checking on what we are eating. We are not ordering food from outside. We are eating home cooked food. We are being physically active. We are catching enough sleep. And we are having a good social, circle, which motivates to do things better, like maybe going for a walk together, going for a cycling session together. That usually adds to your dementia prevention or aging prevention.
But how much of it is probably lifestyle related? When somebody who is, say, 70 years old, 75 years old comes to you, you see that they have early onset dementia. How much of that is possibly what they've done in their early years, say in their 40s or 50s or maybe even 30s?
See, that is also very important because, see, the diseases which we see in 60s usually start in 30s. If somebody continues to have overweight in their 20s or 30s, they are more likely to have hypertension and diabetes. If somebody is not being physically active and being sedentary, that again adds to inflammation in the body and overall leads to less cognitive ability. So those people who continue to have obesity, don't take care of their hypertension, don't take care of their blood pressure, they are more likely to have it.
Okay. Well, Dr. Thakur, just coming to you with regards to that, 80% of chronic diseases, again, according to data, shows that it begins in the 20s and 30s. So when we are talking about longevity, when should we actually start thinking seriously about longevity?
The seeds of aging are sown as early as the 2nd and 3rd decade of life, because there is erosion of organs, of cells, of hormones and everything else. So which is why you have to practice regularity, punctuality, limited indulgence, and a disciplined exercise, diet, sleep regime. That doesn't mean that I'm sounding like a priest who's going to only preach. You do have lacunae where you can have the sporadic bursts, what we call a diabetic date in our diabetics. But all in all, you have to follow the rule of lifestyle. If you start early, a stitch in time gains 9. So you have to start early So you don't bring on the diabetes, the hypertension, the lipids, which are accelerators of aging.
But who's thinking about all this when in their 20s and 30s?
We have to think. We are today talking not only for our 70-year-old citizens. We are talking to them so that they can advise their 20 and 30 and 40-year-old relatives or friends to begin early. Because if you want to reap the fruits, you must have a good harvest and a good sowing season.
So what should they start practicing in their 20s and 30s, or what should they refrain from?
You know, Saturday nights in our country means party, late night, binge, everything else. Saturday night in some countries means sleeping early, so you can go rowing, you can go camping, you can go sporting the next day. So you have to cultivate this art of sleeping well to do physical exercise, of eating healthy. That doesn't mean you don't party. And if you have good interaction with happy, healthy, not chasing target lifeline, that sows the seeds and you begin early.
But how much of this is probably genetic, aging?
Definitely 20%, maybe 30%. Because if you have the genes passed on to you, which tell you that, look, in your family, this is the programming of the chromosomes, then you have a 70% chance of altering your lifestyle to not pamper the bad genes, but to play to the gallery of the other genes and slowly work towards lengthening it.
That just brings, it just sort of gives me an example of cardiovascular diseases as well. A lot of people have genetic cardiovascular risks as well. But there is this whole condition of VO2 max, which is basically trying to see the endurance that you have in, or the maximum amount of oxygen you intake when you are exercising. Have you looked into that? Are patients talking about it?
In fact, you will find that the knowledgeable ones and the enlightened firms are all inculcating gyms, health programs. At one of the leading media houses where I am attached to, they have a canteen which gives health food. The servings are all programmed from that point of view. At offices where I am advising, they have a gym in the office. So if you can't walk and work out in the evening after a long day, you get that 30 minutes in the daytime. So you can begin. It's not impossible. Where there is a will, there is a way. And if the will tells you that you want to burn the candle longer, then you need to work brighter on the candle so you can enjoy longevity.
Well, Dr. Kohli, just wanted to come to you about preventive testing, because when you speak to, most of your peers or your friends, they say, oh, nothing's wrong. I don't need to get any sort of preventive testing done. Hum to theek hai, until something goes wrong. What do you tell your patients? What is the checklist of, say, preventive testing that you subscribe to your patients, and at what age would you prescribe it rather?
See, we have to see the diseases like hypertension, diabetes, high cholesterol. They are very important and they are not picked up. So there is a saying about hypertension that only 50% of the people who have hypertension, that they know they have hypertension, out of which half of them do not even get treated and half of them are undertreated. So conditions like hypertension, if there is a family history, and even if there is no family history, they have to be regularly checked. So at least once a year, there should be a checkup where we check about how is our thyroid doing, how is the blood sugar doing, and there should be regular monitoring of blood pressure as well. If there is we are being overweight and BMI is high, that also needs to be monitored and the weight needs to be reduced.
Okay, so if you had to if you had to recommend maybe the lowest effort, highest impact change in lifestyle, what would it be, Dr. Kohli? Because, some people say that 8,000 steps, 10,000 steps, or even 12,000 steps reduces your mortality risk significantly. So what is it that you would recommend as a doctor?
See, it depends upon what person likes, which they don't feel burdened to do it. So it has to come naturally and effortlessly. See, it can be as simple as walking 7 to 8,000 steps in a day, or maybe doing some kind of aerobic exercises, or doing some kind of strength training 1 to 2 times a week, or going for a cycling 30 minutes for at least 2 to 3 times a day. So any kind of physical activity which they do regularly and persistently over a period of time will actually help them.
Okay, so you would put exercise at the top of the list?
Yes, exercise, yes. And dietary, definitely the second one, because diet is also very important. We are eating all kinds of processed foods which are having high refined carbohydrates and not eating proteins, especially in our Indian population, which leads to ultimately sarcopenia and low muscle mass, because muscle needs proteins to grow up. And once the muscle mass is less, there are more chances, you're becoming more vulnerable to have infections, you're more vulnerable to have falls, you're more vulnerable to, not recover very well from the illnesses, and the cardiovascular as well as your brain health deteriorates because.
Okay, but there is a whole set of people who believe in a plant-based diet and who believe that vegan diet results in longevity as well. So how do you balance the protein part of it there?
So they have to take supplements for that, and they have to be more physically active, and they have to make sure, especially those people who have a family history. So they have to be more physically active, and even the vegan diet is okay, but then they have, for making proteins, they have to take some supplements also. And on top of that, they can go to, the strength training can be a major part for them so that their muscle mass gets maintained.
Okay, so is strength training possibly more important as we age? If you could just give us more details in terms of how important strength training is and from what age especially.
So strength training is very simple. More strength training means better muscles. Better muscles means we are able to endure more and we age slowly. And the strength training should begin early, even if, ideally it should begin early, but even if we are in 50s and 60s, we do some kind of a moderate strength training, which can be, the functional training part also without using weights. That also adds up to making muscles, toning up the muscles and falling less sick.
Okay. All right. Well, Dr. Thakkar, we've spoken about exercise now, and that probably is one of the top of the list in terms of increasing your longevity. But a typical Indian diet is quite high in terms of carbohydrates. So how important is diet when it comes to aging, or diet when it comes to longevity? And what would you recommend for the Indian diet?
So diet is probably the most important, because depending on what you eat, you will make in the body, and what you don't make in the body, you will accumulate in the body. As my colleague said, proteins are extremely important. In the formative years more, in the later years also important, because if you're doing some strength training, the protein requirement also is high. So you need a significant amount of good first-class protein, which you have to moderate in your diet. You also need non-trans fats. And then the Indian habit of having carbohydrates for everything has to be toned down. I'm not saying don't have carbohydrates. And whatever you have should be easily assimilable and easily expendable. The Indian habit of celebrating everything with sweets is something which is a very crushing phenomena to the body as a hormonal system. It's a very lovely phenomena to the tongue and the eyes and the taste buds. But you have to be careful regarding how you balance the proteins and carbohydrates and fats. And having said that, especially for the aging population, nutritional supplementation, micronutrients, essential supplements, from magnesium to zinc to so many other components are extremely important. And they come into play not necessarily in the age of 50s and 60s, but omega-3 fatty acids, B12, vitamin D3 are all important constituents that you need at every phase of life.
But you must do a possible blood test before you get it done to see what your levels are and go to a physician.
If you do a blood test and you know what your levels are, then you can implement a regime. And if you are punctual and loyal to the regime, you don't need frequent blood tests. After the 5th decade, you need annual tests. But I wouldn't tell my 30-year-old necessarily to go and do a test every year. He can do it every other year.
Now, just, you spoke about celebrations. So one of the other points which is widely spoken about is about how relationships and social connections, in fact, play into longevity. And of course, we have the Harvard study which identifies that. And it is expected to be a top predictor of long-term health, even above smoking alcohol. So how important is social connections for longevity?
Very important. Companionship, camaraderie, social interaction, wanting to be with somebody, belonging somewhere, interacting with different people. It not only stimulates the mind, but the neurotransmitters thereafter go and help in keeping. Remember, a happy person is a healthy person. We have patients in the hospital who are happy, who heal earlier and go home a couple of days early. The same logic implies, rather than a grouchy, solitude, isolated person, a healthy, happy person who mixes, who probably has a shoulder or many shoulders to lean on, to talk with, those interactions are as important as food.
Just a few minutes left, so we have a rapid fire. So I'm going to just ask Dr. Thakkar as well as Dr. Kohli a couple of questions. And if you could just answer them in, maybe a word or so. So Dr. Thakkar, I'm going to ask you first. Aging, can it actually be slowed? Yes or no?
Yes.
Okay. Dr. Kohli, one test every Indian above 30 years of age must do.
HbA1c and thyroid levels.
Okay. Dr. Thakkar, one daily habit that adds the most years to life.
Walking.
Okay. And is 8,000 steps enough, or do we really need 10,000 or even 12,000?
8,000 is enough. 7,500 is also enough.
Okay. All right. Dr. Kohli, what's more important for longevity, sleep or exercise?
Both. Sleep early, get up early and go for exercise.
Okay. One food, Dr. Kohli, Indians must cut down on immediately.
Mithai.
Okay. Dr. Thakkar, fasting, is it a longevity booster or is it just a trend?
Intermittent fasting is a trend. Regular fasting that you do for 12 hours when you eat early and sleep early is healthy.
Okay. One supplement, Dr. Thakkar, that's overrated.
One supplement that's overrated, General B complex vitamins.
Okay. And one supplement that actually works.
Vitamin D.
Okay. And Dr. Kohli, I'm going to end with you. Is longevity expensive, or can most of the gains come from free habits?
It can come from free habits.
Okay. And what would be the top habits?
Watch what you eat, get physical activity going, take less stress, have a good social circle which motivates you, and get your regular checkups done. And yes, it can be, prolonged.
Okay. All right, Dr. Kohli as well as Dr. Thakkar, thank you very much for joining in and speaking with us on CNBC.
Hopefully, we'll meet 40 years from now because we are going to practice what we preach on the same program.
Absolutely. That 100%, Dr. Thakkar. Thank you very much for joining in.
Hello and welcome to Business 360. I'm Arundhati Ramnin and here are the headlines that we're tracking for you this evening. Nifty hits a 52-week high and comes within 30 points of the record high. Sensex gains nearly 500 points. Nifty Bank and Midcap Index hit a record high before giving up some gains in late trade. Nvidia reports record sales and profit in the third quarter. Growth outlook also beats estimates, soothing frayed nerves on Wall Street, dispels fears over AI valuation, at least for now. United States approves the possible sale of Javelin missiles and Excalibur projectiles to India worth nearly $93 million. This comes just days after India signed a deal to buy cooking gas from the US, accounting for 10% of LPG imports in 2026. M&M targets organic growth of 15 to 40% across businesses till 2030, aims to be the world's fastest growing SUV brand and the top light commercial vehicle brand. Mahindra Holidays invests 1,000 crore rupees to foray into leisure hospitality. Starbucks CEO Brian Niccol says India sits at the heart of their global strategy as it brews its 500th store in the country in partnership with the Tatas, highlighting that US tariffs has not impacted sourcing as India has a localized supply chain. That's an exclusive. Supreme Court refuses to prescribe timelines for governors and the President of India to clear bills passed by state legislatures, signals limited judicial scrutiny for prolonged, unexplained and indefinite delay in granting assent to bills.
मैं नीतीश कुमार सत्य निष्ठा से प्रतिज्ञान करता हूं
JDU Supremo Nitish Kumar takes oath as the Chief Minister of Bihar for the 10th time after NDA's landslide victory. 26 other MLAs, including BJP Samrat Chaudhary and Vijay Kumar Sinha, sworn in as well. Prime Minister Modi, Home Minister Shah and top NDA leaders attend the ceremony. Any peace plan on Ukraine must take Europe and Kiev on board, say EU officials. This after US and Russian officials draft a peace plan which will require Ukraine to give up some territory and downsize its military. 28 people were killed in Ukraine after Russian strikes yesterday. At least 32 killed in Gaza in 24 hours in Israel's latest violation of the US-brokered ceasefire. Dozens injured as per Gaza's media office. Over 280 have been killed and more than 650 injured in nearly 400 Israeli violations since the October 10th ceasefire. Those were the headlines that we're tracking for you this evening, but straight to the day's market action. Sensex and Nifty hit 52-week highs after a steady session on Dalal Street. In fact, the Nifty was just 30 points away from its record high during intraday trade. Both indices did give up some gains in late trade. Nifty Bank and the mid-cap index hit a new record high before seeing some profit booking. The mid-cap underperformance kept the market breadth in favor of declines. Surbi Upadhyay is here with all of the action from Dalal Street. Surbi?
Let's dissect what really transpired today. So today, if you talk about the leading sectors, then defense, infra, oil and gas for sure, thanks to Reliance, capital markets, autos, and even banks. Banks didn't lead from the front, but they did chip in, and I'll get to more of this in just a bit. The lagging sectors today, real estate, pharma, healthcare, and PSU banks. Let's see how this translates into actual Nifty stocks. So Nifty gainers, Reliance Industries, like I'm saying, and the other heavy hitter, HDFC Bank, contributed quite nicely. Axis Bank was up and about, and auto stocks had a pretty good session, specifically some of the two-wheeler names like Eicher Motors as well as Bajaj Auto, both those stocks up between 1 and Eicher, the Nifty winner actually, going up to almost 3% gains. The losers then, some consumer stocks like Asian Paints, Titan seeing profit taking. Lever was also down, and some of the tech names that did very well yesterday, they cooled off today. So names like Infosys and HCL Tech, to name a few. Now let's come to the mid-cap part of the market, and that was the only grudge, so to speak. Because mid-caps underperformed large caps, the index was more or less flat, and the advance decline ratio was also negative, more declining stocks than advancing stocks in the market today. So let's talk about the movers, the big listings or the recent listings. Today was a day to come down to gravity. So Growth, second day running, managed to see a cut, 6-7% down on Growth. Physics Wala was also slightly lower. Hyundai had a bit of a rough session, 3% down on Hyundai Motor. Biocon, and like I said, IT, not just large cap, but even mid-cap IT, which was sizzling yesterday. Today was some profit taking on names like L&T Technologies. There was Coforge and Intellect Design. Let's talk about the gainers on the upside. Today, Mahindra and Mahindra, the group had its investor day. So some of those group stocks were really surging. M&M Financial, for instance, 4-5% higher. Mahindra Holidays, which is also getting into the leisure and hospitality space. Now, that stock was up about 3.5% as well. Beyond that, there was Radico, Khaitan, Network surging thanks to the strong performance from NVIDIA. And then some other names like Canara, Robeco, AMC, 9% higher on this one. And even IEX had a good session, 4% up.
Right, Surbi, many thanks for those details. Now, chip maker NVIDIA quelled fears of an AI spending bubble with a strong third-quarter performance that surpassed Wall Street's expectations. Net income rose 65%, riding on the back of a 66% year-on-year increase in its crucial business data center sales. The world's most valuable company's guidance for the fourth quarter sales was also stronger than what the street had factored in. Hormaz Fatakia is here with all of those details. Hormaz?
Too good to be true. That's not possible. Mano ya na mano. You can use all of these phrases when you look at NVIDIA's results this quarter, but the numbers don't lie. It is what it is. Now, yet another blockbuster quarter from the world's most valuable company, and markets across the globe are breathing a sigh of relief. Now, we all know NVIDIA's results were a beat on expectations, but that's not it. Here's a bigger picture. Now, for the first 9 months of the year, NVIDIA has reported sales of close to $150 billion, profits of close to $80 billion, and for the fourth quarter it has made a projection of $65 billion in sales despite the issues in China. Now, if this guidance holds, the company could well end the year with sales of over $200 billion and profits in excess of $100 billion. But how big is too big? Here are some illustrations to show how big NVIDIA actually is. For the first 9 months of this fiscal, NVIDIA's profit is $77 billion. Now compare that to the sales reported by its closest competitors, Intel and AMD, for the same time frame. That is close to $60 billion. This shows that NVIDIA is earning more than two of its closest rivals put together are managing to sell. Now that is some statement. Now, more than the results, the global markets are also breathing a sigh of relief from Jensen Huang's remarks. He mentioned on the earnings call about the AI bubble, saying that from their vantage point, they see something very different. And when the CEO of the world's largest AI chip supplier says all is well, the market surely takes note of it. NVIDIA recently hit $5 trillion in market cap. You heard that right, $5 trillion. Now, the journey from 4 trillion to 5 trillion happened very quickly. It took only 79 trading sessions. We hit 2 trillion in Feb of 24, went to 3 trillion in June of 24. Then we had a bit of a sell-off. Then we hit 4 trillion in July of this year. And then we hit $5 trillion very recently. Now, the last time when the stock had hit $4 trillion, we tried analyzing what if NVIDIA was a country. Today, we tell you what if NVIDIA was a stock market on its own. After a brief post-listings, post-5 trillion slump, the market cap is now below that $5 trillion mark. But even at 4.5 trillion, NVIDIA is only smaller than the stock markets of China, Japan, Hong Kong, India, and of course the United States. Here's another illustration of how big NVIDIA is. Out of the 13 quarters of the fourth quarter of FY23, NVIDIA had sales of around $6.5 billion. Now, for the current ongoing fourth quarter of FY26, the sales projection is $65 billion. That's a 10x jump in just 3 years. The exponential growth shows up in the stock price as well. Between 2020 and 2024, NVIDIA stock has doubled or even tripled in value in 4 out of the 5 years. Even this year, the stock has more than doubled from its tariff lows, but such was the damage that even today, the year-to-date gain is only 35%. CLSA has retained its high conviction outperform rating on the stock with a target of $270. Despite this surge, only 1 out of the 79 analysts that track the stock has a sell rating on it. If CLSA's target is higher, there are targets even higher, as high as $350 on NVIDIA. So in this battle of David versus Goliath, the Goliath keeps getting bigger and better, and the Davids around it are also cheering the results with share price moves of their own. NVIDIA has categorically stated that the AI boom is here to stay, and it wants to have the largest share of that pie, one chip at a time.
So in NVIDIA, they're getting bigger and better. Thank you, Harmas, for those details. Now, the United States approved the possible sale of Javelin missiles and Excalibur projectiles worth nearly $93 million to India. The Excalibur deal is for $47 million and the Javelin deal is for $46 million. The U.S. said that the package includes 216 Excalibur artillery rounds and 100 FGM-148 Javelin missiles. This comes after India signed a deal to buy cooking gas, indicating a potential easing of trade tensions. Federal Reserve officials were at odds during the October meeting over cutting interest rates. According to written records of the meetings, the officials were also divided on whether the central bank should cut rates next month. The minutes indicated that most participants felt that further rate cuts were warranted, but not necessarily in December. However, participants does not denote voters. There are 19 participants at the meeting, but only 12 vote. And speaking of the Fed, U.S. President Donald Trump said that he would love to fire Jerome Powell. Addressing the U.S.-Saudi Investment Forum in Washington, the president also said that Treasury Secretary Scott Bessent needs to work on Powell to quickly lower rates, indicating that the Treasury Secretary's job depends on it.
Mortgage rates are down despite the Fed. Scott, you got to work on this guy. He's got some real mental problems. No, he's something wrong with him. It's just sweet. I'd be honest, I'd love to fire his ass. He should be fired. Guy's grossly incompetent, and he should be sued for spending $4 billion to build a little building. I'm building a ballroom that's going to cost a tiny fraction of that, and it's bigger than the whole thing put together. You got to work on him, Scott. The only thing Scott's blowing it on is the Fed. Because the Fed, the rates are too high, Scott. And if you don't get it fixed fast, I'm going to fire your ass, okay?
Shares of pharma major Zydus Life Sciences rose as the company onboarded 3 investment bankers for a 5,000 crore rupee fundraise. As per a Money Control report, they are Jefferies, JP Morgan and IIFL Capital. Money Control has also reported that the funds will be raised via qualified institutional placement, which is likely to be launched at the start of 2026. Infosys' 18,000 crore rupee share buyback opened today, making it the company's largest buyback to date. The buyback, priced at 1,800 rupees per share, will close on November 26th. Infosys aims to repurchase 10 crore fully paid up equity shares. The company said the buyback is intended to return surplus funds to shareholders in line with its capital allocation policy. Promoters who hold just over 13% will not participate in the buyback. Investors continued to book profits in newly listed broking firm Grow, which fell 9% today. The stock, which had rallied nearly 90% since listing, has now slipped 18% in just 2 sessions. This amid stretched valuations and shorting by traders. The stock's market capitalization now stands at 98,000 crore rupees. The Mahindra Group hosted its annual Investor Day. The conglomerate is targeting organic growth of 15 to 40% across businesses till 2030. The group aims to be the world's fastest growing SUV brand and the top light commercial vehicle brand. Mahindra Holidays is foraying into leisure hospitality by creating a wholly owned subsidiary with an investment of 1,000 crore rupees. CNBC-TV18 spoke to the CEOs of all Mahindra Group companies, and that special show will be broadcast at 6:30 a.m. tomorrow. Representatives from the tourism and hospitality sector are with Finance Minister Nirmala Sitharaman for pre-budget consultations. Sources say the sector has sought industry status, which has been a long pending budget demand. They have also sought clarity on GST treatment, especially on how rates apply to room tariffs amid dynamic pricing. Single window clearance system for the hospitality sector is also one of the key demands. Starbucks CEO Brian Niccol has said that India is one of its fastest growing markets as it gears up to open its 500th store in the country. In an exclusive interview with CNBC-TV18, Niccol outlined their India growth plans. He said that they were in India building a coffee culture for the long term. Starbucks runs its India operations through a 50-50 venture with Tata Consumer Products. On that note, it is time for us to head into a short break. But coming up next, Supreme Court refuses to prescribe timelines for governors and the President of India to clear bills passed by state legislatures. More details on the other side. Stay tuned. Welcome back. The big national story today. JDU Supremo Nitish Kumar took oath as Bihar's Chief Minister for the 10th time after a landslide NDA victory in the assembly elections. The 74-year-old is now India's 8th longest-serving Chief Minister. 26 legislators, including BJP Samrat Chaudhary and Vijay Sinha, took oath as well. The contours of the new cabinet are yet to be formalized. A majority of the MLAs who took oath along with Nitish were from the BJP. Prime Minister Narendra Modi, Home Minister Amit Shah and top NDA leaders attended the oath ceremony at Patna's Gandhi Maidan. The Supreme Court has refused to prescribe timelines for governors and the President of India to clear bills passed by state legislatures. But the top court signaled limited judicial scrutiny for prolonged, unexplained and indefinite delay in granting assent to bills. This comes after a rare presidential reference was made to the court over its verdict in April, which imposed a 3-month deadline on dealing with bills passed by state assemblies. Ashmit Kumar is here with more on the court action. Ashmit, explain the Supreme Court's observations today and its implications.
Well, first up, it was in the month of April that a bench of the Apex Court itself had granted this order, had directed for a 3-month deadline to be imposed on the President as well as the Governor. It is in response to that we had a presidential reference, which is in the nature of a question. The President is asking a question from the Supreme Court that can such a deadline be imposed by the Supreme Court on the President who happens to be a constitutional office bearer. Now, that was the question, among others, that was being dealt with by the Apex Court. And then, as a part of an opinion, today's the findings that the Supreme Court has given is an opinion. It is not binding on the government. It is only, it has a guiding force, but nonetheless, coming from a bench of the Supreme Court of no less than 5 judges, it does carry a significant amount of weight. Now, what does this opinion to the presidential reference say? Well, this opinion clarifies that as far as deadlines are concerned, timelines are concerned, that is simply not the court's power. It simply does not have the remit, the power, the jurisdiction, the scope to start telling the President and the Governor that, look, this is a timeline within which you have to decide on bills that are being sent to you by state assemblies. That's one. But having said that, there are a number of caveats that the Supreme Court has given with respect to powers of the Governor. All of this issue, of course, arose with a number of opposition-ruled states, the likes of Kerala, Tamil Nadu, Punjab, raising the issue before the Apex Court that bills are being passed by the state assemblies, the governors are sitting on them indefinitely. To that end, this opinion by the Apex Court has clarified that, number one, the governor has 3 options. He can either agree, he can send the bill back to the state assembly or refer it to a president. What the Supreme Court today clarified is that the governor cannot sit on it indefinitely, cannot defeat the entire legislative exercise, that it is the cabinet, the elected government that needs to be in the driver's seat, that this is something that the governor cannot do. What the Supreme Court has also said, that as far as deciding of this granting of assent is concerned, to that end, while the Supreme Court says that no deadline can be prescribed, the Supreme Court also says in the same breath that there needs to be a decision by the governor in a reasonable period of time, leaving the door open that tomorrow, if there is a situation that a bill is being passed but is awaiting the governor's assent, the governor is sitting on it indefinitely. There is a window now available for opposition-ruled governments to actually come and approach the Apex Court. So clearly, the Supreme Court trying to do a balancing act, on one hand saying that no timelines can be prescribed, but also in the same breath saying that governors cannot sit on these bills that are being passed by the state assemblies indefinitely. They need to take a decision, and they need to do so in a reasonable period of time.
All right, Ashmit, many thanks for those details. Now, India's Commerce Minister Piyush Goyal is in Tel Aviv on a 3-day visit to push for the long-pending free trade deal with Israel. He is leading a 60-member delegation to focus on deepening trade, investment flows and innovation partnerships. Abhimanyu Sharma reports from Tel Aviv.
India's Commerce and Industry Minister Piyush Goyal is on an official visit to Israel. He's expected to meet Israel's Minister for Science and Technology as well as Israel's Minister for Economy, Nir Barkat. In course of the next few days, there are B2B engagements expected between the Indian and the Israeli industry since a 60-member delegation from India from across several businesses is already present in Israel. There is also a likelihood that a potential FTA between India and Israel may also be discussed as part of the ongoing engagements. India is looking for more collaboration with Israel in several areas, particularly in areas of technology, innovation, wastewater treatment, and several possible joint ventures between both the sides. Now, several Indian companies are already invested in Israel and vice versa, and both the sides are looking to increase this engagement and possibly elevate this engagement by means of a free trade agreement between India and Israel.
I can assure you, friends, our first quarter growth was 7.8%. Our second quarter numbers are expected soon, will be about 7%. And I think at the end of the year, our year ends on 31st March 26, we will be growing at 7%, well above the world estimates.
Israel is a great startup nation, India is a great scale-up nation. So how do we, the real conversation was how do we combine the technological leverage that Israel has versus, and using that technology to do advanced manufacturing in India, to partner on AI and other advanced technologies, to look at sustainable things like sustainable areas of sustainability, like particularly in water, agriculture, and obviously energy transition.
And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV18.
biggest risk that you've ever taken?
Quit a well-paid job and start ID along with my cousins.
First business lesson that you remember?
Cash is reality. Everything else is vanity or sanity.
Rapid growth or sustainable growth?
Sustainable growth.
What is the greatest lesson of your life?
Don't wait for tomorrow. Tomorrow never comes.
Who inspires you the most and why?
My dad. He worked in a farm, ginger farm, for 12-13 hours every day to feed us. My dad skipped one meal every day to educate me. If my dad can take me to where I am today, all of us can do wonders in the world. That's why he is my role model.
Your forever hero.
Superhero. He still goes to the farm. That's exactly the same thing that he used to do earlier. No change.
So is there something that he said to you that is the compass, the moral compass for you in your life?
Do good things. I learned the power of determination from my mother. During the difficult times, my mother used to go to the forest, collect the wood and come and sell in the street to support my dad. I don't think I can find better role models than my parents.
What was the first thing that you made in the kitchen?
Papad.
Papad, of all things. That was the first thing that you
Friday, yeah.
What was tougher, the first fundraise or making the first dosa?
Dosa. I still don't get my dosa right. When I make dosa, it takes the shape of Australia. Even now.
Is there an innovation coming there?
Yes. Coming soon.
Coming soon. How soon?
Dosa spread is coming soon.
You know.
Work in progress.
Work in progress, so a couple of months?
Maybe one more year.
Your favorite ID Fresh batter and why?
All of them are my babies, right? So I don't think I can choose.
From a 50-square-foot kitchen in Bengaluru to kitchens across the world, ID Fresh Food has redefined convenience, authenticity and trust in India's ready-to-cook space. Hello and welcome to the Young Turks Reloaded podcast. I'm Shireen Bhan. Built with 50,000 rupees as seed funding and a family recipe, the brand today reaches millions of households across India, the UAE, the US, UK, Singapore, and even Saudi Arabia, powered by 5 manufacturing hubs and a 680 crore rupee top line. With clean label innovation at its core, from idli dosa batter to parathas and chutneys, ID has turned everyday staples into a national fresh food movement. And now it's gearing up for its next phase of growth, ID 2.0, with plans perhaps for an IPO. At the heart of this journey is PC Mustafa, the son of a daily wage worker from Wayanad in Kerala, who went from failing class 6 to graduating from NIT Calicut and then IIM Bangalore, and then building a 5,000 crore rupee brand that's redefining India's fresh food story for the world. PC Mustafa, what an absolute pleasure to have you back with us here on Young Turks. Thanks very much for joining us.
Thank you.
17 years, Mustafa. There are memories that, in hindsight, define who we become, shape our journeys. If you were to go back in time, are there those points that you can identify that kind of have defined your journey so far?
There are many such, defining moments in the history of ID. One such incident was, maybe around 2013 time. We were doing a business and reasonably doing well in Bangalore. We thought we are wasting our time in Bangalore. We are not in the Chennai, the Mecca of Idli. So we went ahead and started a factory in Chennai. Almost 7 years of our profits were invested in setting up a factory in Chennai. After launching the batter in Chennai, we learned that Chennai is a very, very tough market. We were trying to sell batter at around 40 rupees a kg. That time, the local batter in the market was available for less than 20 rupees a kg. It was not even my raw material cost. What we learned was that there were a lot of unethical, unhealthy practices being practiced by many local players in the market. They were buying this 1 rupee rice available in the name of politician, adding chemicals and soda in it, making idli dosa batter and selling it so cheap. We were not able to compete with those local players in the market. We started losing money. Salary payment was delayed for almost 6 months. Many of our key employees left. ID was on the verge of shutdown around 10 years ago. That time we had 3 options in front of us. Option 1 was to follow the local practice that is being done by local players in the market, which was to buy the 1 rupee rice, which was illegal, and add soda chemicals, unhealthy, and sell at a cheaper price. We said we didn't want to do that. The second option was to borrow the money from the bank on an interest-based transaction. ID, even today, we are a zero debt, zero liability company. We don't pay interest, we don't take interest. We didn't come from a rich family background. Idli business was not a fancy business for somebody to come in and invest at that time. So we had only one option left, which was to shut down the factory. So we decided to shut down the Chennai factory, sold the assets, cleared the salary payments backlogs, came back to Bangalore and started focusing on business in Bangalore. After shutting down the Chennai factory, I felt crying. I felt crying not because we lost our 7 years of profit. I felt crying not because I had to vacate Chennai market. I felt crying because the Almighty God gave us the courage to take the toughest decisions in the most difficult time in our life. It's very easy to make money, but making money without taking shortcuts, making money without adding chemicals and preservatives in the food is not easy. We decided to travel that path less traveled.
You know, you talked about the fact that people didn't think of getting into the idli making business or the idli dosa batter business. Why did you decide to bet your life on that?
So there were two reasons for us to look at it. First of all, the journey of ID was started in a small setup at my cousin's place. My cousins were running a small time kirana store in a place called Intra-Day in Bangalore. There was a idli batter vendor who was supplying idli dosa batter in a plain pouch with a rubber band on the top. You will still see in some part of Matunga in Mumbai now, right? This had all sort of quality issues, service complaints and hygiene issues. My cousins tried to fix this issue with the vendor multiple times. It didn't work out. And that's when we thought, why don't we do it ourselves? And that's where the journey started. When we started this, we wanted to test it with 20 stores. Objective was to sell 100 packets in 20 stores. It took us 9 months to sell 100 packets in 20 stores. But
almost
then we
like
didn't
having a baby.
almost like a baby. Yeah. So, but we didn't give up. If you look at the atta business at that time, the chakki atta business, chakki atta was actually getting popularity into the packaged form, right? And there were many such category which was getting branded, pickles, right? Masala powders, paneer, curd, all of them are getting branded and branded price organized, right? That's when we thought, if it can happen for atta, why not for batter?
You know, it's not just the fact that you decided to get into pre-packaged batter. You also decided to bring in innovations which have really changed the way that women, and now men of course also, use the batter in their kitchens. Take me through that journey of this frugal innovation that is really core to the ID Fresh success story. And who came up with the idea?
So it was again a team effort.
And all of you are still together, all
yes,
four of you.
All of us are still together. Innovation in the idli batter packaging came from a customer complaint. I was getting a lot of customer complaints saying that there is foreign particles in the batter. Even though we were small at that time, we were maintaining our factory like an operation theatre from day one. There was no way a foreign particle could come into the food. And it was like a regular complaint. So what we've learned during the journey was that customers were, or initially if you look at the ID batter pouch, the regular pouch that you get, they had to cut open and then transfer into a vessel, make idli or dosa out of it. We try to educate the customers saying that, wash the pouch before use. Doesn't happen. So if it is not washed properly, there could be foreign particles on the packet outside because the product is kept along with vegetables and other things. So those foreign particles get into the final idli. We had to solve that problem, and that's where we came up with this concept called a different kind of packaging. And the real inspiration for the packaging came from the transformer. You know the transformer which becomes a car and then Superman, right? So we said it should be a pouch during packaging, transit and storage. But once you open it, it should become a vessel so that you don't have to transfer the contents to another vessel. And that's how this innovation came up.
So the idli batter packaging got its inspiration from the Transformers. Is it really? I mean, one would never have imagined. One would never have imagined that. But then you did the same as far as vadas were concerned.
Yes.
And how did that happen? Was that also based on customer feedback?
No, vada was completely different innovation for us. If you look at the vada batter packaging, it was easy for us to make vada batter because we are doing idli dosa batter. Getting vada batter right was not that difficult for us.
Yeah.
But even if I give you vada batter, you still can't make vada at home. Vada batter is as sticky as a super glue. It's a messy job to make vada at home.
Yeah.
You can't get the shape right. You can't get the size right. And most importantly, the hole. Today, a homemaker can make vada at home in less than a minute using the ID vada batter pouch.
Can
By
you?
squeezing. You can.
No, can you?
I can.
Do
Even-
you?
Yeah. So even I can make. But then it took us hundreds of failures and 3 years to build a hole for the vada.
3 years and before you actually managed to perfect that.
Yes.
What was the complicated aspect of the
When
most
you-
complicated aspect
When
of
you
it?
get the shape right, you won't get the size right. When you get the size right, you won't get the hole right. To get everything right, you have to get the pricing right.
Huh.
It took us close to 3
Clearly,
years.
vada making is rocket science. But
It was.
Yeah.
Now, vada for dummies.
now vada for dummies. You talked about the fact that right from day one, you wanted your factories to be, in your words, like operation theatres. What did it take for you to set up a factory that was almost like an operation theatre right at the very beginning?
I don't think we had the large setup during the initial days. What I mean to say is, it was a small kitchen.
Yeah.
Right? But we maintained the hygiene like in operation theatre. That's what I meant. I think the best thing that happened to ID was when we went to Dubai to set up a factory. We thought we can set up the factory easily, but the approval process out there was very, very complicated.
Harder than India.
Yeah, when I said approval process, the guidelines that they set for you to get the final approval was very, very difficult. But we managed to get the final approval. But that is a good learning for us. Then we thought, why don't we replicate this model across other plants? And that's how the modernization of the factory happened. I think I want to clarify one more point to you when I said the operation theatre model, right? So 3 things that we do we have been the pillars in the decision making for ID. 1, if you walk into my factory, you will not find any ingredients that my mother will not use in her kitchen. Whatever goes inside the food should be exactly same set of ingredients that my mother used in the kitchen, nothing else. Second, my factory should be as hygienic as an operation theatre. Third, before I send any products to market, I test it with my own boys, my kids. If they're comfortable, if they're healthy, then I send to the market.
Have they ever rejected anything?
There are many.
Really?
Yeah.
How instrumental has your mother been to the ID Fresh story? You said every ingredient in the factory is a replica of what your mother has on her kitchen shelf. And was it her recipe that got things started?
My batter is better than her batter.
Your batter is better than her batter. Does she agree with you?
She has to agree because that's a fact. But unfortunately, she still makes batter at home.
She's not using ID Fresh.
She still makes batter at home.
So where did the original recipe come from?
My cousins, figured it out. It was from our own family and, the roadside vendors that we reached out to. There's no rocket science in making idli dosa batter. But it took us 1 year to get the consistency right. Right set of ingredients, right proportion, right fermentation level. And we didn't come from a, food technology background.
Yeah.
So we had to experiment ourselves and make a lot of failures and learn from that.
So what is the hardest part? And, I think a lot of people who are looking at getting into the food business and what is the hardest part of going from idea to actual execution in light of the experiences that you've had?
I think the most important aspect is to get the product right. If you don't get your product right, don't waste your time. Because at the end of the day, the product has to be the hero.
Standardizing and then scaling it up across different locations. Have you been able to put together now a template which you can share with people?
Yeah, now we are able to replicate it very well. In fact, we are now starting our Saudi factory. I just went to Noida factory today and told Murthy that just replicate this factory in Saudi. You don't need anything else.
Just replicate this factory in Saudi. You make it sound so easy, right? How does Murthy replicate this factory in Saudi? Please tell us.
So Murthy has a playbook to get it right.
It takes me back to 2021. And that's the last time that you and I spoke.
Yes.
Where there was a massive backlash against ID Fresh.
Yes.
Because of messages that went viral on social media accusing ID Fresh of using animal extracts in your batter. And we spoke then, and you, of course, came out and denied all of those allegations. You battled all of the accusations that came the way of ID Fresh. You opened up your factories. I remember very distinctly.
Yes.
You opened up your factories. Virtually, people could visit an ID Fresh factory. But for a company that based its entire philosophy, its ideology, its USP on the fact that you were anti-chemicals, anti-preservatives, to now have to deal with the fact that you were putting in animal extracts into your batter. How challenging was that crisis for you as you look back at it today?
I look at every challenge as an opportunity. That initially was a challenge. Initially, I thought it's some random messages. But as you mentioned, it started going viral. It started getting coverage in different media as well. And that's when, we had to come up and deny the allegations. But I think that did a lot of good things for the brand ID. Many of my customers and people like you came in support of the brand. And they had visited the factory, they had been using the product. And most importantly, it also gave me an opportunity to demonstrate to the world what ID is. Right? Until that time, I was talking about preservative-free, chemical-free, soda-free batter. People wouldn't believe. During that time, that crisis, we used an opportunity. We put up our factory live. We were the first company in the world, food factory in the world, to live stream the factory. We had nothing to hide. 8.32 lakh people visited the factory, live stream. Even today, we get visitors to the factory. We get grandmas and school kids coming in to audit the factory.
Let's talk about ID 2.0.
Yes.
17 years on, plenty there in terms of milestones that you've been able to achieve. What next now? I mean, an IPO is something that you're now actively considering?
Yes. We are looking at an IPO in 2 years. October 27, 2 years from now.
That's quite specific.
Yes.
Why October 27 particularly?
That's how the planning is done. Right? All set, planned. The process already started. We should be completing the IPO process by October 27.
And what do you intend to do with the money? How much money would you like to raise?
Yet to finalize. We haven't thought of, raising primary in that round. Let's see. ID is a profitable business. It has enough, reasonably good cash in hand. So we won't need any primary immediately.
So why then the need to IPO?
IPO was a dream. When we started, it was a dream. And hopefully in 2 years, we will be there.
So the dream was to be a listed company? Because clearly it's not about the money.
Dream was to be a listed company and become a role model for the world by doing ethical business. Without taking any shortcuts, without taking any compromises. Can it be a billion-dollar business?
Can it be?
It can be.
By when?
2 years.
2 years? So to coincide with the IPO?
Yeah.
What are the milestones that you're now working towards? You're in a bunch of countries at this point in time. You're expanding your India business. You've expanded your product portfolio as well. So what are the next milestones that you're hoping to hit? What are you working towards?
As I told you, to build a clean label fresh food for the world from India. Maybe something like a Nestle from India, right? Could be the ID's next milestone for me.
Now, you're crossing many roads across many parts of the world at this point in time. So Saudi is going to be the next place where you set up your factory.
Yes, coming
what
soon.
What else in terms of your global ambitions? And what has been the most exciting but also the most challenging aspect of going global?
We have been trying to start our operation in US. I've been trying it for a couple of years now. I don't think we have been very successful in getting the operation done or started properly in US. I've recently hired a CEO for international business. Shobit has joined us recently to build this business or expand this business globally now.
Why has US particularly been so hard?
US is a large business opportunity.
But it's also a large
market. Large
yeah.
country,
yeah.
right? This product are highly perishable fresh food. With all those things, it is not that easy to get it right. And then the most important problem would be bandwidth as well, right? I mean, it was easy for me and my cousins to start in Bangalore, then go to Chennai and neighbor places. Other markets, we will need experts like Shobit and Rajat to take the journey forward.
So now, on the execution side, you have the professionals.
Yes.
So what occupies the founders today? What occupies you, for instance?
I look at technology, one aspect. I look at some innovative products, etc. That, and some disruptive ideas. That's my area of focus.
You're
now.
the disruptor in the band, is it?
Sort of.
What are you hoping to disrupt next?
We will disrupt any category of food where people are adding chemicals and preservatives and artificial flavors.
Is there anything in the pipeline, anything that we can expect to be out on the shelves anytime soon?
One thing that we are testing now is a clean label noodles.
Noodles? It's a highly competitive market. You want to be the Nestle, you want to be like the Nestle from
fresh
India.
I said fresh noodles.
Fresh noodles, okay.
Clean label, fresh noodles.
Fresh noodles.
That's something which we are testing now.
Mm-hmm.
The way the new products work is 1 out of 10 becomes a super hit. So unless I try 100, I'll not get 10 right. So we will try multiple things. One such product would be this one. Another thing that I'm very confident that we will get it right this next time would be the tender coconut.
Tender coconut, which you're not giving up on.
No.
But I also want to ask you, we're living in a world where the GST environment has changed. In fact, GST as far as parotas were concerned was a national debate, raging national debate. How are you looking at it from your vantage point?
We were paying VAT initially, it was 5%. In the initial GST thing, it became 18%. And we appealed. I think that is still in the judicial process. So no comments about it. Now the government has made it 5%.
Yeah.
No, 0% now.
Yeah.
So even better for everyone.
So do you see that impacting demand in a significant way? Yeah.
Hopefully it will.
So you see that as a game changer?
I wouldn't say game changer, but an enabler.
PC Mustafa, always a pleasure. Thank you so much for your time again today. We look forward to ID Fresh 2.0. We look forward to seeing you being listed on Dalal Street and creating a multi-billion-dollar fresh food business here from India for the world.
Thank you.
Thank you very much. Well, with that, it is time for us to wrap up this edition of the Young Turks Reloaded podcast. If you enjoyed this conversation, do send us your feedback and your views and suggestions. We always like to hear from you. From all of us here, for now, from the team, goodbye. Many thanks for watching.
Hello and welcome to a special Market Masters edition that coincides with the end of the second quarter earnings season. The question we're asking our guests is whether the results season shows a clear recovery in Indian earnings and hence will the foreign investors return. Our guest today is Timothy Moe, co-head of Asia Macro Research and Chief Asia Pacific Equity Strategist at Goldman Sachs. We have invited him because Goldman Sachs has just turned overweight on India from their underweight position almost 13 months ago, since October 2024. Timothy, thank you very much for coming into our studio. That's
thank you
making
very
it
much.
all the better. Okay, well, straight away, why have you turned overweight on India?
Really, Lata, the reasons are that the causal factors for engendering our downgrade 13 months ago, as you mentioned, have dissipated and look as though they're turning aside. So to be specific, we downgraded for two main reasons. One, that a lot of India's good news got priced into the market valuation in September, October of last year, when the market was trading about 25 times forward earnings. So we've been very positive in India, as many people have been, but felt a lot of that was in the price. So that was number one. And number two, we had a developing conviction that there would be what we were terming a mid-cycle slowdown in the economy and in earnings. And as I'm sure you're aware, when you have a richly priced stock meeting a downgrade, you tend to get some hyperactive move to the downside. So we just felt, look, let's step back here and take our foot off the accelerator and take our view down. And we're fortunate that our timing was reasonably apt. And since then, India has underperformed by the most in a decade or two, particularly compared to China, which has come out of its doldrums and has had a very good year. So if you look at the scorecard for year-to-date market performance, China's up 35%, and India just recently was up only 2-3% in dollar terms. And that's MSCI India, but Nifty pretty much the same. So what we figured, to your question, is, well, number one, there's been some moderation in valuation, not colossal, but the market was coming down to maybe 22 times. So it kind of grown into its valuation to some extent. Number two, quite clearly, the economy had slowed down, but was showing signs of stabilization. And in fact, even has printed above expectation numbers for second quarter of calendar year, first quarter fiscal year. And we've been toning up numbers overall. And then at the market level, there's clear signs that the persistent downgrade cycle for earnings has really stabilized. If you look, for example, at a measure of breadth, number of analysts downgrading versus upgrading, and this is your zero line, we got to really, really deep. Almost everybody was downgrading. Now it's basically flat, and even there's a touch of upgrades. And if you look at the most recent quarter, which you mentioned, the expectation coming into that was about 9% year-on-year growth for the full market. It's actually going to come out more like 14, about 5 percentage points above. So it really, there are signs at the earnings level that things are coming into play. So you put all that together, and we just feel that the risk reward for India is now turning more favorable, especially because foreign investors have sold, since they started selling last year, about $30 billion US in this downgrade, this down selling time, which is the second largest in absolute terms and relative to market cap on record. And even year to date, there's about 16 billion in net selling, which has gone on. And so if you've got lighter foreign positioning, you've got an economy which is stabilized, looks like it's picking up a little bit. Earnings, we think, will grow on a compound basis, maybe 13, 14% next couple of years. Market valuation is still rich, but acceptable. We did a bunch of work on that. We just feel risk reward looks better for India. So we figured it's time to pull the trigger.
Very good. That suits us. But do you, which sectors are you impressed with? Are you impressed mostly with consumption? Because that's where the government has given everything it can. Rate cuts, tax cuts.
Indeed, Lata. So we very much like the mass consumption theme. So I'll answer your question this way. There are a number of themes that we particularly like, which, as I said, to start with your question, would be mass consumption, because obviously the underlying dynamics, demographics, large population, per capita incomes are rising, people's consumption habits change. This is your classic sort of developing market or developing economy story, and we think that India has much to play for in that regard. Additionally, we like the theme of self-sufficiency, and this plays into defense, into energy sufficiency, and so forth. So there's a lot of aspects there. Our analysts just did a very large report, 140-page report on initiating on the Indian defense sector. And defense is a theme which we've liked regionally and globally, and I think for many reasons, which I'm sure we'd all agree with.
Yes.
In a fractious geopolitical environment, which we find ourselves in today, the theme of defense is one that's played very well, and we think India has some catch-up to go in that. And so we're quite excited about that theme, along with the theme of energy sufficiency. We also like the theme of the new economy. This is leaning into the digital economy and more delivery.
E-commerce.
Correct. Yeah, e-commerce, fast delivery, all that sort of stuff, where you see a transition from your analog to digital economy. It's not a theme unique to India, but there's a lot to play for in that regard. And then just simply the theme of high growth, where we find there are many companies that are offering good growth opportunities, particularly in the smaller mid-cap space, where you've got early emerging companies that tend to do better. So we like those four themes. And then from a sector perspective, that will be manifested in a number of the consumer areas in terms of durables. Some of the financials, the banks have particularly come out of a period of credit constraint. And so we actually initiated an investment view of longing financials versus Nifty. We thought that was an interesting catch-up performance trade for the banks. And then some select higher growth areas as well. So that's sort of our view within the market.
Okay. Just zooming out, what would be your pecking order, since you specialize in all of Asia? What's the pecking order in terms of countries in Asia?
Well, it's a great question, and frankly, we're a bit spoiled for choice here, because we like a lot, and I think the trouble we're having in terms of finding things that we don't like as much is, I think, an indication that the broader appeal and potential for Asian equities actually still looks pretty good, even after a very strong year. MSCI Asia Pacific ex-Japan Index is up 25% this year, and 40% off the lows in early April. And so we think that can continue into next year for reasons we can explore a little bit later. And as I said, we're somewhat spoiled for choice. So to be more specific, we've had a very positive view on Korea, which is the superstar this year.
Because of the AIs.
Yeah, stratospheric performance. It was up 90% nearly in dollar terms. And it's had a bit of a correction, but still up roughly 80. And one might think, well, after that, it's probably going to cool off. But even with that significant performance, Korea is still trading at 11 to 12 times earnings. And a good part of that is that, number one, the earnings delivery has been very strong because of the AI theme and so forth. But also, we're having a re-rating structurally of Korea because of better corporate governance, which I can get into further if you wish. But the point is that this rally in Korea started literally from 8 times earnings. So even if you're up a lot, you've only reflated to 11, 12 times earnings, which means there could still be plenty more to go for. So we like Korea. We like China. We just put out a view that over the next 2 years, we think China can go up 30% in price terms, maybe another 5% in dividend yield. And again, we think there's some structural reasons there. Taiwan, which are market weight on, but also looks good because you've got a very strong AI component there and some broader tech elements. So North Asia, we think, still looks good, including Japan, by the way.
Okay.
But then India, we like also. Maybe it's a bit early, and maybe it's going to take a little bit of time to catch up, but we like India as well. So those would be our top picks. To balance that out, in an Asia perspective, we're underweight Australia because it's richly valued and doesn't have as much growth. Not that we're necessarily outright bearish, but think it still will perform less well than the others. And then trying to be underweight as much of ASEAN as we can. These are the smaller markets, Indonesia, Malaysia, Thailand, Philippines, and so on. because they just don't have as much of that tech-focused driver.
Yeah. Clearly a developed country choice more. But, you know, the start of this year, not start, maybe after the Liberation Day, after February 1, announcements from Trump, economists actually turned very negative on global growth because of uncertainty. You won't know where to invest in which product because you don't know when you will be hit by how much tariffs. That was the narrative we got. But in your report, you'll have upgraded growth forecasts for practically every region, for the world, for the US, for parts of Euro area, and of course for Asia, in a big way, even for India.
Yeah.
Why did it change?
So, great question. So, first of all, we and many other economists are upgrading our forecasts on a fairly dynamic basis, given the information which comes in. And so the point of reference that you took just after Liberation Day was the nadir, the worst part of the forecast, because at that point we were looking at very, very elevated tariffs. And of course, there was this sort of tit-for-tat escalation between the U.S. and China, where you had such colossally high tariffs that it basically was equivalent to an embargo in trade. And of course, that would have been very, very damaging for both economies. So we marked down our growth views dynamically quite aggressively. And just to give one or two numbers, we started this year, taking China as an example, with about a 4.8% GDP growth forecast for the full year. And that got marked down to about 4.1 in early April. But then, of course, as some of that tariff increase was walked back, and in China's particular case, we saw exports doing much better than one had thought, than we had thought, and I think consensus, we progressively marked up our numbers, so much so that today we're actually standing at 5% GDP growth for this year. And we just did the biggest upgrade to our China forecast in probably a decade, adding 50 basis points and 70 basis points to our 2026 and 2027 numbers. Now, because of this leaning into high-tech manufacturing and China's export competitiveness, and also the leverage they've got through rare earths. So the point of all this is that we've seen kind of a walking back of some of the worst fears, number one. Number two, to your question, that sort of reduces at least some of the uncertainty and makes it a little bit better environment for investment. Number three, a lot of that investment has come in, particularly in the U.S., in the hyperscalers and AI, which is really separate from the whole tariff area of concern. And then number four, just if you look at the data which has come out, just empirically, the world seems so far to be doing better than one would have thought given the higher tariff levels. So people are just learning to live with it to a better degree. So all of that contributes to that increase in the growth forecast.
What do you think will be the catalyst that other foreign funds will wake up to the change in sentiment over India? Do you think this catalyst could be only the trade deal? Unless that happens, people are not going to come in?
So I think it's a few things like that. So if there is an announcement between the U.S. and India, as seems to be rumored, of course, the market would look at that as a good thing, because if this extra, for example, 25% tariff surplus is eradicated, and maybe there's even agreement to go to something along the lines of what both Korea and Japan have arranged bilaterally with the United States, which is about a 15% base case, with maybe, in each case, Korea or Japan buying more from the U.S. and then also investing more in the U.S. If there's some sort of agreement along those lines with that sort of flavor, I'm sure the market would take that well. Now, I don't think that the full 25% additional tariff surplus has been fully priced in, because most investors thought, well, it's probably not going to last for a long time. But the market has certainly expressed and priced some sort of concern over that. So if you know for sure that's not going to be there, that's going to be a positive. So I think that in terms of near-term catalysts, that's one which we can look to. But the other ones, I think, from an India-specific perspective, really would be delivery of growth, because I think the broader picture for India is that valuations are full. I mean, 22 times earnings, hard to argue things are on sale. We did a big piece which looks at valuations from a variety of different perspectives, and the punchline is that we think that these valuations are defensible, but we're not calling for an increase here. We think there may be even a little bit modest decrease, but roughly speaking, we could hold on to the current level. Ergo, in order to really power India and to rekindle foreign investor interest, India earnings have to come through. So I think it's really earnings delivery as we go through time will be the catalyst to get interest coming back.
A final question, and this is a macro market conflict I have in my head. India's macros have improved. we were a country up until, 2013 with a 6% inflation on average. And because we adopted inflation targeting and went after it, now we have, constrained our fiscal deficit and inflation is averaging about 4%. That is reflecting in lower nominal GDP and probably impacting earnings. But that's a good reason why earnings and nominal GDP are lower, because we controlled inflation. Don't you get brownie points for that? Or do investors like you only look at the earnings number?
No, it's a great question. I concur with you. I think that if you have an environment where you have better real growth or very good and solid real growth and inflation under control, that is a much healthier environment. And I think full credit to India for the fiscal consolidation which has taken place, but it's been done in a gradual manner, so you kind of thread the needle between wanting to be more prudent fiscally without doing so much that you then hurt growth and have a negative spillover effect. So I think that the policymakers have done a very commendable job in that regard. I think that the silver lining, as you said, in that slight cloud of lower nominal GDP is that a lower inflation environment certainly allows the RBI to be more accommodative. And I think it also may calm fears about currency weakness. So if you get a more stable rupee and lower interest rates, well, lower interest rates are obviously good for markets through valuation. So I think that there's that positive pass-through effect from lower rates, which may mitigate the lower.
Well, you're right that the inflation differential narrowing so much between India and the US is not reflecting in the currency just yet.
Correct.
But do you think the rupee's worst is over?
So our overall view, as I mentioned earlier, is that the US dollar should weaken on a structural basis. India's had some challenges this year, and the rupee's been on the weaker side, along with the Indonesian rupiah. But we think here it's sort of probably roughly range traded stable. So we don't think it appreciates as much as some other currencies, for example, the Korean won, which I think is very undervalued here. It should rise, and the Taiwan dollar as well. But we think it can sort of hold its own. So I think from a U.S. dollar investor perspective, you're probably okay in U.S. dollar, keeping score in U.S. dollars. And then the real heavy lifting will have to be done by earnings delivery and growth.
Thank you very much, Timothy Moe, for your views and for dropping into our studio today. I do hope other funds follow Goldman Sachs' view and change their view on India and rate it overweight. Well, we have to take a break on that note, but I'm back with another guest on our Market Masters edition. Leif Eskison, the chief economist from CLSA, will join us after the break. Welcome back to Market Masters. So, the show where we are asking if India is on the cusp of a re-rating. My guest now is Leif Eskison, the chief economist at CLSA. Leif, good morning, and thank you very much indeed for joining us. Well, let me start by asking you that India's second quarter, what we call second quarter, July, August, September quarter, GDP number is due in a week. Has there been a recent upgrade from CLSA? What's the number we should be prepared for?
Yeah, so if you look at the current fiscal year we're in, we're looking at growth coming in just a hair below 7%, so 6.9% to be exact, right? So relative to the first quarter of the fiscal year, it does, you can say, imply some slowdown in growth during the remaining 3 quarters of the fiscal year. That sort of slowdown, I would say, is sort of driven essentially by 2 factors. One is because the government has to sort of rein in to some extent, you can say, spending to meet the deficit target. We think there'll be some sort of slowdown on that side, maybe sort of government-led infrastructure type investments. And then also the sort of, should we say, lagged effect of the higher tariffs that got imposed on India from the US. And also a slowdown we're seeing in global trade in the, should we say, in the incoming quarters as well, would be the 2 factors that will drive that. I guess if we start to see the effect of some of the GST reform, that could provide a bit of a lift to the consumption side of things, right? So that's why the slowdown we are looking at in the remaining of the fiscal year is not that significant. So as I said, full year fiscal at 6.9%.
Would you put an upward bias to that 6.9 because of the GST cuts and the probability of a trade deal with the US?
Yeah, certainly, I think the chances of a trade deal have gone up, right? I mean, Trump has certainly indicated as much, and the two sides are still negotiating on that front, right? So whether it happens on this in this calendar year or in the beginning of the next calendar year, so the last quarter of the fiscal, we'll have to see, right? But I suspect that we could move towards a deal, right, where maybe the tariff rate that's imposed on India lands at something similar to what we're seeing for other Asian economies, to say around 20% thereabouts, right? And then, of course, there'll be some give and take also in terms of purchases and opening up for certain sectors, etc. That would be part of that broader deal, sort of in similar fashion, but not quite the same as we've seen from some of the other Asian economies, right, where they've entered deals with the US.
Okay. Well, is there any, I mean, this is not really an economist's question, it's more your equity strategist question, but do you see the global view on India changing? We've seen the largest amount of foreign investment outflows from India. Now, as the GST cuts and the income tax cuts in India work in and earnings improve, and probably the trade deal comes in, do you see the movement of funds back into India? I mean, a lot of the rupee depends on that. That's why I'm asking.
Yeah, I mean, so I think, given our view on, should we say, U.S. equities being quite frothy, right, and should we say a little bubbly, if you will, right? I mean, we do also see a relatively high probability of a correction in U.S. equities, and that also would imply, should we say, more of a sort of less risk appetite, more broadly speaking, globally, right? So I think it will be hard for Indian equities to sort of buck the trend in that type of environment. But if you look, should we say, beyond that potential correction, and if there's also maybe some further correction in India in the context of that as well, right, and valuations are maybe somewhat less, should we say, challenging to the extent they are now, then maybe there could be a bit more scope if we start to see the GST reform adding to the growth impulse in India, right? And if growth holds up relatively well, that there could maybe be some resumption on the other side of this of equity investors coming in, right? But I think valuations still are quite high. I think positioning domestically is still quite long in the tooth as well, right? So I think that is still something that does pose, I guess, challenges from the point of view of foreign investors in the near term, right? So maybe a healthy correction could be a good sort of starting point, right, for seeing flows coming back in.
Okay. Well, just a final word. How many rate cuts do you see from the Reserve Bank? Is it just one in December or, more?
So we currently have two, 25 basis points in each of the two following meetings, right? So we're not buying it. We're not looking for 50 basis points in December, which I think came up after the latest inflation number, right? But I think what you need to look at is, if you look at core inflation, right, in India, it's still at around the target, right? So I don't think there's necessarily a case for cutting by 50. So 25 basis points in December, and then subsequently another 25 basis points.
Okay, got that. Thank you very much, Leif Eskison, for joining us and giving us a view of both the US economy, the global economy, and where Indian rates are headed. Thank you very much for joining us in this special edition of Market Masters.
Well, hello and welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. Today on Finding Alpha, we decode the big shifts shaping India's consumption universe, the leadership transformations, intensifying competition, and sector cycles, all of them at play. The questions that we're asking: are the major headwinds easing for paints? Can Britannia maintain its momentum post Mr. Varun Berry? And is Titan ready to sparkle again despite competition? Joining us to break all of this down for us is Mihir Shah of Nomura. Well, Mihir, thanks a lot for coming down to the studio. Good to have you in person. And, before we get to discussing all those topics, Congratulations on that big call on paints as well. Let's discuss all things consumption. Mihir, thanks for coming down.
Thank you, Nigel, and pleasure to be here.
Well, let's get straight then to the hot topic, paints, right? Now, at the start of November, you had this anti-consensus call. You went ahead and you upgraded both Asian Paints as well as Berger Paints. Could you tell us what were the key factors that led to this kind of shift in view, and what changed fundamentally in the industry or maybe on a company-wise data point? Tell us what made you take this bold call.
Absolutely. See, the paint sector was, going through some overhang, largely because of fear of competitive intensity, disrupting the growth profile and margin profile. This actually came into light after Bilaupus had actually highlighted a very significant large investment of 10,000 crores. Now, historically, there have been many other paint companies that have, forayed into paints, but such large capex was never announced. So it remained to be seen whether it will be impacting the sector or not.
Yeah.
So that was the key overhang the sector was facing. What we have realized over time, over the past 2 years since the launch, is going to be just a few months away from their second anniversary of launch. We saw that the disruption that was expected or there was fear, we saw, it was not materializing enough.
Yeah.
If you see the product prices, the product prices are very similar to the other legacy players. They were giving some introductory offer of 10%. If you see the dealer margins, again, a shade higher, but nothing significantly higher to cause any kind of disruption. If you see the impact on margins of Asian Paints or Berger Paints from their normative levels, they were just down about 200 basis points or 100 basis points during this phase of, launch and expansion that was there.
Right.
Growth profile, yes. In FY25, we saw growth for Asian and Berger actually to come down. But we believe it was not only because of competitive intensity, but was also a function of overall weakness that we were seeing in consumption.
In the industry.
So many other categories also were seeing weakness in consumption. So much so that Prime Minister Modi had to come and give some relief on GST across various other categories.
Indeed.
So it was not only a function of competitive intensity, but a culmination of many things. And also, if you recall what happened post-COVID in paints, the organized paint players saw significantly higher volume growth. They were, taking share from the unorganized guys. And we believe that there was some amount of preponement of paints that also happened during that phase. Folks were sitting at home.
Yeah, they wanted to.
It is a, it is a budgeted activity, both time-wise and money-wise. And hence, there was some preponement which led to this impact on sales. We believe that, so that was, part one. The other thing that we started, when we did our surveys with the dealers and distributors, we realized that the parabolic growth that the competition or the new entrants were seeing, that has started to moderate down.
Okay.
They've come to more normalized levels. Maybe a function of they've already reached about 50,000 dealers that they were targeting to reach in 3 years. The 10,000 crores of capex that they had wanted to invest is kind of almost exhausted completely now. So going forward, we realized, and then some of the dealers were lost to the new entrants were started to coming back. So we realized disruption is not materializing. Having said that, from here on, growth is going to be, or competitive intensity is going to be more normal rather than disruptive. And our call was that if after putting in such a significant amount of money, if it has not derailed the legacy players, then why penalize them?
Got it. All right. Got it. And that's an important point you're making. You're saying competitive intensity will remain healthy, but it will not remain disruptive, as was feared earlier. Let's talk about the, the big conglomerate that did come in then. Birla Opus. Well, they've already deployed the initial capital, as you said. But given the group size, the concern could be whether they will double down on the investments and put in more money. If the Aditya Birla Group decides to come in there and pump in more money, do you think it'll add some kind of fuel to this disruption fire? Or do you think, no, they're pretty much done with this 10,000 crores odd?
No, you're absolutely right. I mean, while upgrading, we did think of this scenario, other scenarios like maybe another superstar CEO can again join them.
Yeah.
There are various many scenarios. But our call is not about competitive intensity, our call is about disruption no longer being there. I'll take a leaf from historical examples. If you remember what happened to Jubilant FoodWorks margins when Zomato, Swiggy, food aggregators were coming about 7-8 years back, margins were like completely halved. If you remember what happened to Lever's margins during Lever P&G detergent price war back in 2003, margins were half. We've not seen any of the disruption thus far. We believe that there are very strong moats that these legacy players have, and they will continue to, play these moats and defend their share. Of course, competitive intensity, we are not calling out that it will completely go away. It will remain healthy. Yeah. It will remain high. But will it cause disruption? Not as much.
Okay, all right. Valid points then out there. You were saying that the big conglomerate came in there, didn't really shake things up to the extent that the street was fearing. Maybe some compression on margins, maybe growth slowed down, but that was more an industry phenomena rather than the disruptor that's coming in there. Now, since your big call that you made on paints, in early November, Asian Paints is up, what, 17% or thereabouts. You have Berger as well that's up close to around 8%. Now, backed by strong quarterly performance, does Asian Paints still have legs from year on? Do you think, it can still move up, even Berger Paints? And to borrow a line from, your note that I saw, ain't no mountain high enough. Is there more altitude left in this sort of a rally that we've seen?
No, we do think that there is more legs to the room, simply because very rarely you see, all the three tailwinds coming together. The tailwind of a probability of volume seeing an improvement, a tailwind of margin seeing an improvement, a tailwind of PE re-rating that is likely to happen.
Yes.
And like I said, we still expect competitive intensity to remain high. The recent results that we saw for Asian Paints were ahead of estimates from, by our estimates and also from the street estimates. Volumes came back to double digits. That was not expected. In a weak quarter, in a monsoon quarter, they expanded their margins by 240 odd basis points. That was not expected. We believe that the steps that the company has been taking over the past 3, 6, 9 months has started to yield results, and going forward they can probably maintain this kind of trajectory. We have built those in our numbers. We believe that in a weak quarter when they've done these kind of margins, in the second half we are expecting margins to go up as about 19-20%, which is at the higher end of their band. Now, over the next 2 years, we are still forecasting margins to stay close to around 19 odd levels. We are not, taking it, further higher, which means that as we saw a surprise in the first quarter, if there are more dots, they will make a line, they will make a trend, and then probably you will see that, like how we, became constructive. If you see most of the street still is on the negative side or has a sell rating, there'll be more people who will get constructed. We will have to bake in more fundamental improvement. That's what we have already baked in right now. And hence there will be more legs to the stocks.
All right, and the official rating as well as target price up for our viewers on the screen that Mir has. Well, Mir, the industry has moved from one disruption to another. Let's talk about the jewelry space. Is the threat from lab-grown diamonds now meaningfully behind us? Or is that still a bit of an overhang for the jewelry ecosystem? Because paints is done. What about jewelry sector? This, lab-grown demand suddenly had derailed it in the middle. Then some of these players have adapted to it. So what's your take?
You're absolutely right. There was a lot of disruption in the past couple of years across various subcategories in consumption. In jewelry, while the curiosity around lab-grown still remains, the adoption is still, getting along. We believe that if you see, there is very little evidence that it has impacted the industry, Indian jewelry industry, or for that matter, Titan's studded sales as well. If you just see over the past 12 quarters, Titan's studded growth has been about 19% CAGR. In the peak of LGD euphoria, if you see some Google searches on trends on how lab-grown is getting searched, the search rates have actually started to come off a bit. The prices of lab-grown have continuously, corrected, and that is, again, there's a lot of question mark around where will it settle down.
Yes.
Again, the resale value for lab-grown is not there. Sure. The reason why Titan grew its studded jewelry by 19% and did not get disrupted is largely because of small diamonds. So lab grown actually impacted the prices of solitaire, which is 1 carat and above diamonds globally. And because of the prices of solitaires went down, the demand went down, and they were impacting them.
Right.
But the prices for small diamonds, which the Indians wear in their jewelry, that did not see any impact.
Got it.
And that is why we have not seen any evidence that lab-grown is substituting the studded jewelry for Titan, or it is impacting the growth profile. More so, if you see for Titan specifically, studded jewelry is 30% of sales. Within that 30%, solitaires are just about 15%, which essentially means
5%,
only 5% is what exposure the Titan has to lab-grown's disruption.
Okay, all right. Just to take that argument forward, within the jewelry space, Titan has been the so-called Hira, because that's always been, shining bright. While peers, they have sparkle, but only in phases. Some of them have sparkle, and then they have just, fallen by the wayside. Now, despite this 20% run that we have seen in Titan, in the last 1 year, actually in the last 2 years, the stock has virtually been unmoved. Do you think that this consolidation that we've seen on Titan is setting it up for better times? And also a quick comment, people sometimes argue Titan at 60 times expensive. What do you have to say to that? Such a rank outperformer.
No, you're absolutely right. I mean, the reason why this stock was around flattish for 2.5 years, before the move that we saw, a month ago, was getting impacted because of the lab grown, because of higher competitive intensity that was feared. A lot of new regional players were coming about, hitting, tapping the public market money, expanding stores. There was some pressure on margins because of that, because of higher competitive intensity. Now with the margins kind of resetting is base for Titan, and more clarity that lab grown is not disrupting, we started to see, things again moving. Even the high gold prices was feared that, optically, the gold prices are crossing a lakh rupees.
Now prices have cooled off a little bit. That will help demand, I'm guessing.
Correct. Footfalls have started to come back. So there was a lot of headwinds or feared headwinds that was there. While Titan was holding up, there was little evidence that, it will continue to, keep its momentum high or not. We believe all these things are behind. More so, we've put out in our report also, we see Titan as, it was forged under pressure. When the existence of Titan came in, came in an industry where it was completely unorganized.
Industry was fragmented, margins were low.
Absolutely right.
They made their entry.
And they made their entry. More importantly, if you see right now, the organized industry is just about 40%. Versus if you see most of the other consumption categories, they have a significantly higher organized share.
Yes.
So there is more room for growth. And Titan also has very significant moats. They have very strong customer acquisition tools like Golden Harvest, Gold Exchange schemes. These are all installments-based schemes. And people are comfortable to give their money in installments to Titan rather than to probably a Mihir and Jewelers. They won't be as comfortable to give it to somebody like that. So I would say that they have these strong tools.
Yeah.
They are having the highest trust value, given they're completely transparent, their corporate governance are high.
Right.
And the cohort of consumer that they attract is, at the premium and a higher end of the consumer, which have the propensity to, buy 1.5 to 2 times more than what the GDP growth is.
Got it. So you're bullish on Titan's prospects from here on. That challenge with regard to lab grown wasn't such a big challenge for them. But, that as well is moving aside. And now the company is, posted for better times, and the target price comes up for our viewers on the screen as well. Let's talk about a biscuit, Britannia. The transformation of the last few years has been super. That was under the leadership of Mr. Varun Berry. Now, as we know, he's moved on. So in the post-Berry phase, what gives you confidence that this sort of a momentum in growth can be maintained, the innovation that we saw, the sustainability of the business as well? Because you're fairly positive, and the multiple you're giving actually is a premium than what we have seen in the last 10 years or so. So explain that bullish call on Britannia post Mr. Berry.
No, you're absolutely right. I mean, difficult question. We upgraded Britannia in August after the 1Q results because we saw that Britannia is in a sweet spot. It will also post the GST. It will be one of the key beneficiaries of the GST reduction that is there. 65% of its products are at 5 and 10 rupee price points, which means that technically they will do much better as GST actually addresses the 65% of the bottom of the pyramid households in India, where we had seen titrating of consumption happening because inflation was high and wage growth was low. So the relief will come there. So category like biscuits, will probably see one of the key beneficiaries. You're right. I mean, Mr. Berry did transform. When he took over from Britannia, I think margins were about 13 years back. They were close to like about 5%.
5-6%, yeah.
He brought it way back to like 15 to 18,
19%.
closer 19% now. So he's done a phenomenal job on margin improvement, cost coming from Pepsi. He had very strict eye on the cost efficiencies, etc. He brought back volume growth. There's a continuous direct distribution increase that the company is doing, especially in the Hindi heartland where they are under-indexed in their market share versus the overall pan-India index. So phenomenal, work there. Post him, yes, with Rakshit coming in, I think he's also having a very, very decent track record, very worthy successor in my view. We believe that the journey to a total foods company kind of has, is still not yet complete.
Okay.
And we believe that the team, the second-tier management that Britannia has under Varun Berry's leadership, he's pretty strong.
Yes.
They have identified the white spaces, which categories to grow, how to grow. I think they can take over well, from Mr. Berry.
So Britannia's biscuit could remain crispy enough for your liking, and Mr. Rakshit, well, he comes on board and he's as good as any other successor in the business as well. Well, Mir, we're questioning you just to stay with us. We're going to take a small break, come back. We'll continue focusing on the other FMCG companies. Stay tuned. Welcome back. You're still tuned into Finding Alpha, and we've got Mir Shah of Nomura, who's with us discussing the entire consumption theme. We've got a couple of queries actually that have come in. Raghav Iyer writes to us from Hyderabad. He holds around 100 shares of HUL at 2,710 rupees since September 2021. Oh boy. He wants to know the future prospects of the stock. What do you think, Mir? Time for HUL to show up?
Yeah, Nigel, we have a buy rating, and we believe that HUL was ripe for improvement. But with the GST destocking, because the announcement and the implementation had some time, and because of which there was a trade destocking that played through. So the volume growth did not come in as expected. More importantly, the restocking is not going to happen in the same way the destocking happened.
Right.
So the restocking, will probably happen over time and over quarters. So we believe that the improvement, while it is likely, it will be a gradual one. So second half will be better than first. Also with the management change that has happened with Priya Nair taking over, we believe there'll be a lot of new energy into the company, and we are expecting things to get better faster. Plus, given it has the premium end of the portfolio for Lever continues to do well. Given it has a very significant large company and addresses a very large mass market consumption, is where the inflation, like we highlighted in the earlier section, that inflation was high, incomes were low, that was impacting the consumption there, and people were titrating there. We believe that also it takes time as macro comes in place.
So you think, from here on, the stock could actually do well? There are better times ahead for HUL, given the kind of, quarter two was hit by GST and various other factors, but gradually things will start improving for HUL. Is that correct?
Yes, improvement is likely, but it will be a gradual one. It will not be a quick one.
Since you mentioned GST, now I want to ask you about Colgate. That's seen as one of the key beneficiaries, right, of GST 2.0. The stock is already down, 40% from the peak, yet the earnings delivery hasn't really come about. How should investors approach a stock like Colgate, 40% down on a blue chip name like Colgate?
Yeah. No, we have a reduced rating on Colgate. We believe that they are not yet completely out of the woods. Before GST, we thought that yes, probably now things might start turning for them. But again, because of the deferment of this, we still think that the improvement on the volume growth will take a couple of more quarters.
Yeah.
More importantly, there's an inverse duty structure that will put some additional pressure on their margins, and hence their margins also be under pressure for some time. Till all these things resettle, maybe it'll be a couple of more quarters.
So headwinds persist.
Some more headwinds for some more time. Post this, we will revisit our call on the stock.
Okay, all right. Let's squeeze in a couple of more queries. We have Umesh Nair, who writes to us from Kerala. He holds around 630 shares of Godrej Consumer at around 722 odd. Long-term investor wants to know what's the long-term outlook on the stock. Actually, these numbers look good, right? From Godrej Consumer, they did that inorganic growth as well. And you all have been fairly positive on the stock. What's the view?
Yeah, no, Godrej has been one of our topics. We believe that worst is kind of over for Godrej. They were facing a lot of headwinds on the margins because of high palm oil prices. Volumes were pretty decent any which way. But we believe that as palm oils prices have started to moderate down, from next quarter onwards, you'll see a sharp uptick in the India margins. 2Q India margins are close to around 21%. We are expecting them to go to around 23.5–24% in a quarter's time because of the lower palm oil prices. So I think the worst is behind, now, and we are expecting improvement on Godrej from here on, both on the volume front and on the margin front. The other thing on Godrej is that if you see the past couple of years since Mr. Sudhir Sitapati has taken over, they are entering into one or two new categories, increasing the total addressable market, getting into categories which are of the future, which are having a higher growth rate profile. We believe that with the medium term, you will see a very different Godrej portfolio versus what you see now versus the next couple of years. And if the critical mass is got within those newer future brands, the growth profile again will be significantly ahead of peers. So for us, Godrej is a longer term call, getting into newer categories, increasing their total addressable market, doing well on the core, and growing well. So yeah.
Okay, all right, Meir. It's been a pleasure having you on the show. Thank you for taking us through all those aspects. As you said, the big disruption in paints didn't really take about. From the jewelry sector, you like the big boy, the Hira, so to call it, Titan. And Britannia could do well, even post Mr. Berry's exit. And from the other stocks that we discussed, Colgate is a stock that could struggle in the near term, while we have tailwinds that are in the offing for HUL as well as Godrej Consumer. And I think Marico as well, you have a positive call. Thanks a lot for joining in, giving us your take on the consumption space. We look forward to having you on the show yet again. Well, and that's all we have on this edition of Finding Alpha. Thanks a lot for watching.
Hello and welcome to On The Record with me, Shireen Bhan. We're here to talk about a journey that's been steady, exciting and in many ways disruptive. 40 years on for Kotak Mahindra Bank. Joining us now to talk about the road ahead is Uday Kotak and Ashok Vaswani. Gentlemen, congratulations and many thanks for joining us. Mr. Kotak, I want to start with you. Starting with 30 lakh rupees, a small NBFC, 40 years on to where you find yourself at Kotak Mahindra Bank. What is the most gratifying aspect of this journey so far? But more importantly, what's the ambition from here?
I'm excited about the fact that India has transformed so dramatically in this 40 years. But when I look at the journey from here and the future for India, the financial sector and Kotak, I'm even more excited. So this is just a point in time in history. 40 years may seem a long time. For me, it seems like yesterday. And it is exhilarating in terms of the opportunity ahead.
But, speaking of the opportunity ahead, what is it that you foresee in terms of where you believe the bank will be, in terms of pecking order, in terms of your loan book, in terms of your global aspiration? Where do you foresee the bank? I'll come to the execution aspect with Ashok in just a second.
I would love to see Kotak as one of the leading global scale financial institutions from India. And that's my dream. It's not about just how large we are, but also how good we are and how we are keeping pace with the times and demonstrating that we can break the glass.
Well, break the glass ceiling, Ashok Vaswani. It falls on your lap then and your table in order for you to deliver on that promise. But, he says 40 years feels like yesterday. It's almost 2 years for you here at Kotak Mahindra Bank. Feels like yesterday?
Oh, it definitely does. It's been an incredible ride. And I'm so happy I made the decision to come back to India and take on this assignment. That was a good decision.
A good decision, but to build on what we just heard there from Mr. Kotak, world class, but also world size. So let's talk about the ambition in terms of how much you intend to grow your loan book, what you believe it could potentially look like over the next few years. Today at about 5 lakh crores, Axis Bank just above you at almost 11 lakh crores. What is the aspiration on that front?
So, Shirin, actually it is about an ambition on profitability, which is obviously linked to balance sheet, but essentially profitability. How, as a group, can we become maybe the third largest, most profitable group, financial services group in the country amongst the private sector kind of banks, and more importantly, really serve our customers and become, the kind of most valued franchise from that perspective. And that's the journey that we're on.
Well, speaking of that journey, and you just unveiled this One Kotak sort of campaign and One Kotak ambition that you've put out there as far as customers are concerned. How should investors read that from an unlock and a monetization perspective? Could we potentially look at some of your businesses being unlocked, being monetized in the near future, or is that not a consideration at this point in time?
So, Shirin, think about it. Kotak is the broadest financial conglomerate in the country. There's nothing that's like the Kotak financial conglomerate. This conglomerate allows us to take advantage of whatever changes may be happening in the financial services sector, whether it's in saver to investor, whether it's corporates going from bank balance sheets to corporate bonds, capital markets. We can serve these customers across the group. That is the power of this group. This also allows us to identify customer segments that we want to really go after, bring together products and services relevant to them, and build out propositions. And where we've done that, we've got really, really good results, whether it's with the private bank, our recently launched Solitaire program, our 811 program, the SME segment, or institutional clients for that matter. That is the power of Kotak, of being able to bring together and meet the holistic needs of the customer. That embedded value is growing. Why would we monetize it early?
No, early, but at some point you will, or intend to?
Right now, very early. We'll see what the future holds. But frankly, I honestly don't see the value of monetizing it right away.
At this point in time, I ask you this also in the context of what you're seeing happening around you. I mean, things like the Grow listing, an 8-year-old company listing in the manner in which it does that kind of tempt you to look at what's happening in the market?
Not at all. The embedded value of Kotak is growing at a compounded rate. And there really is no reason for us to kind of list at this point in time.
So no departure from that?
No departure.
Mr. Kotak, an overarching view on this aspect, because I'm sure that this is something that you discuss and debate very often at the board level.
Shirin, I think the financial intermediation space is undergoing transformation. One is thanks to technology. Second is the move from saver to investor. Third is the flexibility across the intermediation space, which is expected by customers. And therefore, to create inherent disparities between different segments is inconsistent with the best way to serve customers. Therefore, think about yourself. You may be a saver and an investor in one. Therefore, as a financial intermediary, we cannot think about ourselves as a bank or asset management company or as a broker. We've got to think about wherever the intermediation moves, the group is there to serve you. And therefore, if that is the basis, the theme about One Kotak is an extremely powerful theme where the newcomers rightly start with a vertical, But ultimately, the challenge is how do you serve your customer in totality?
You know, you talked about the fact that the banking space is seeing a big disruption and a transformation, and you believe it's going to get harder for banks to be able to get deposits. It's going to be harder for banks to grow in the manner in which we've traditionally seen them grow. So that creates a challenging environment for you. But, you know, on the back of that, what do you believe is the big challenge for banks in general, but also for Kotak Mahindra Bank in specific?
I think that's where the challenge is essentially twofold. One, how do you keep up pace with technology? Because larger deposits are going to market instruments or market platforms like mutual funds. And therefore, the ticket sizes of deposits which remain with banks will reduce. However, there is a large population which needs to have basic payment and banking facilities. The cost to serve in the physical world is much higher. Therefore, how do you create a business model which is commercially viable at the keeping in mind the reality that large ticket lazy money which remain with banks in current and savings accounts will not remain or will not remain to the same extent. Second, how do you capture these flows which are still within the financial system within a group? So combine this, I think, an integrated financial conglomerate with a focus on excellence in the verticals is the key to the future.
Well, speaking of that being the key to the future, and I'm using his words that banking has been lazy, how do you unlazy banking?
I think he talked about lazy deposits and inertia. And that's true, right? With technology, inertia is going to go. And that's exactly the point, right? You need, first of all, the ability to serve a customer in different places. So in this case, it would be, let's say, the bank, as well as, let's say, Kotak Securities or Kotak Asset Management. But even within the bank, Shirin, it's about what are the customer segments that you're targeting and how do you provide products for that? So go back to what Uday said about a vast majority of people who are looking to get basic banking facilities, our ability to acquire them digitally, service them digitally. With our 811 proposition, that's exactly what we're doing, right? And that builds granularity of deposits. That builds, gives us the confidence that we will be able to grow our deposit base to meet our growth needs on the asset side.
But you know, you said that profitability is going to be the focus area for you. So given what we've seen as far as the last quarter is concerned, you know, do you believe that we're perhaps, as far as profitability is concerned, do you feel like you've peaked, or is there something that you can operate by way of levers to do better in terms of profitability? And is the era of 5% kind of NIMs behind us as well?
No, so Shirin, I think we should, looking at one quarter may not be the best way to look at it. Longer term trend, right? I think from here on, NIMs will stabilize and even potentially improve unless there's another rate cut, which is a completely different conversation. I think in our case, you're going to see, like we said at the quarterly results, credit costs kind of moderate. And we are spending a lot of time and effort automating and digitizing Kotak, which is allowing us to get really efficient on costs, right? So I'm optimistic that we can kind of grow our profitability. Last year, capital markets was a very, very good time. You know, we're having a great year. This year, not such a great year. But that again is the beauty of Kotak, right? We fly on 4 engines. Sometimes 3 engines are flying, sometimes 2. The day 4 fly, it's really, really soaring.
When do you believe or anticipate all 4 could fly together?
It's a function of the macroeconomic environment as well. But I really believe we're very well poised to have all of them kind of kick in together and move fast ahead.
The macros, Mr. Kotak, and you said we'll get into the rate cut debate later. So let's get into the rate cut debate. Record low inflation. What's the expectation? Rate cut as early as December or sometime early next year?
Shirin, look at the rate cut syndrome in 2 parts. One is the short term, okay, which has an impact on short term money markets and interest rates in the short-term economy. But long-term rates are more sticky. Therefore, you've seen 100 basis points drop in rates at the short end, but at the long end, the drop is barely 20-25 basis points. So the marketplace actually is saying something. The yield curve, which was flat, is now getting to be positive. And therefore, markets believe that these rate cuts are not going to lead to sustained low rates for the long term. Otherwise, they would reflect in the 10-year bond.
But do you anticipate a rate cut in December or early next year?
I believe between December and February, there's a fair chance of one rate cut.
25 basis?
Yes, that's what I feel.
Mr. Vaswani?
Look, honestly, it's up to the RBI and how data plays up. The data definitely is skewing more towards another rate cut, but let's see how it kind of plays out.
You know, speaking of factors that are impacting sentiment as well as impacting flows, I want to address what we're seeing.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the top headlines that we're tracking this evening. Nifty hits a 52-week high and comes within 30 points of the record high. Sensex gains nearly 500 points. Nifty Bank and Mid-Cap Index hit a record high before giving up some gains in late trade. Global markets rally after Nvidia reports record sales and profit in the third quarter. Growth outlook also beats estimates. Soothe frayed nerves on Wall Street dispels fears over AI valuation, at least for now. TCS partners with private equity giant TPG to pump 18,000 crore rupees into its data center business. TPG will invest over 8,800 crore rupees for a minority stake. TCS will own 51% of the joint venture. United States approves the possible sale of Javelin missiles and Excalibur projectiles to India worth nearly $93 million. This comes just days after India signed a deal to buy cooking gas from the US, accounting for 10% of LPG imports in 2026. M&M targets organic growth of 15 to 40% across businesses till 2030. Aims to be the world's fastest growing SUV brand and the top light commercial vehicle brand. Mahindra Holidays invests 1,000 crore rupees to foray into leisure hospitality. Starbucks CEO Brian Niccol says that India sits at the heart of their global strategy as it proves its 500th store in the country in partnership with the Tatas. Highlights that US tariffs have not impacted sourcing as India has a localized supply chain. That's an exclusive. Supreme Court refuses to prescribe timelines for governors and the President of India to clear bills passed by state assemblies. Signals limited judicial scrutiny for prolonged and unexplained and indefinite delays in granting assent to bills.
मैं नीतीश कुमार सत्यनिष्ठा से प्रतिज्ञान करता हूं
JDU Supremo Nitish Kumar takes oath as the Chief Minister of Bihar for the 10th time after NDA's landslide victory. 26 other MLAs, including Deputy Chief Minister Samrat Chaudhary and Vijay Kumar Sinha, sworn in as well. Prime Minister Modi, Home Minister Shah and top NDA leaders attend the ceremony. Any peace plan on Ukraine must take Europe and Kyiv on board, says EU officials. This after US and Russian officials draft a peace plan which will require Ukraine to give up some territory and downsize its military. 28 people were killed in Ukraine after Russian strikes yesterday. At least 33 killed in Gaza in 24 hours in Israel's latest violation of the US brokered ceasefire. Dozens injured as per Gaza's media office. Over 280 have been killed and more than 650 injured in nearly 400 Israeli violations since October 10th ceasefire. Well, straight to the day's market action, the Sensex and the Nifty hit 52-week highs after a steady session on Dalal Street. In fact, the Nifty was just 30 points away from its record high during inter-day trade. Now, both indices did give up some gains in late trade. Nifty Bank and Mid-Cap Index hit a new record before seeing some profit booking. The Mid-Cap's underperformance kept the market breath in favor of declines. Surbhi Upadhyay, my colleague, is now joining us with a quick wrap of the day's trading action. Surbhi.
Let's dissect what really transpired today. So today, if you talk about the leading sectors, then defense, infra, oil and gas for sure, thanks to Reliance, capital markets, autos, and even banks. Banks didn't lead from the front, but they did chip in, and I'll get to more of this in just a bit. The lagging sectors today, real estate, pharma, healthcare, and PSU banks. Let's see how this translates into actual Nifty stocks. So Nifty gainers, Reliance Industries, like I'm saying, and the other heavy hitter, HDFC Bank, contributed quite nicely. Axis Bank was up and about, and auto stocks had a pretty good session, specifically some of the two-wheeler names like Eicher Motors as well as Bajaj Auto. Both those stocks up between 1 and Eicher, the Nifty winner, actually going up to almost 3% gains. The losers then, some consumer stocks like Asian Paints, Titan seeing profit taking. Lever was also down, and some of the tech names that did very well yesterday, they cooled off today. So names like Infosys and HCL Tech, to name a few. Now let's come to the mid-cap part of the market, and that was the only grudge, so to speak. Because mid-caps underperformed large caps, the index was more or less flat, and the advance decline ratio was also negative. More declining stocks than advancing stocks in the market today. So let's talk about the movers, the big listings or the recent listings. Today was a day to come down to gravity. So Growth, second day running, managed to see a cut, 6-7% down on Growth. PhysicsWallah was also slightly lower. Hyundai had a bit of a rough session, 3% down on Hyundai Motor. Biocon, and like I said, IT, not just large cap, but even mid-cap IT, which was sizzling yesterday,